Let's go. Oh man, this is gonna be fun. Let's get some people in here, man. Let's start. Let's do this. Let's do this. Let's do this. How you guys doing? Welcome in, everyone. Let's get some people in here. Let's get this live up and running. Ready to go. Let's go. Number one Philadelphian fan. It's funny. This is a interesting flavor I got over here. We got a Tetris flavor. Let's get this up and running. Let's go. Oh man. Let's go, Mystic Vibes. Welcome in. It's a Tetris flavor. G Fuel. I wonder how many people are in here. You guys hear me? Let's see. Welcome in, everyone. Welcome in. What? Guest box is all. Are you talking about funded accounts? Wait. Eddie's. Are you talking about funded accounts? What are you talking about here? Dude, funded accounts are complete scam. What the fuck are you talking? Funded accounts are like the biggest scam on earth. It's a negative EV. Hello?
Hey,
Hey, how old are you?
I'm 19.
All right, go ahead.
I was curious, what's your basis for calling the first to a scam?
Yeah. So first one, why would someone tell you something when they can just go and make money with their strategy instead of telling you their strategy or selling it?
How does that make it a scam?
Why would someone sell you something that they could make money off of instead of just making money with it?
Who knows?
Because
I
they're
don't see
making
the
money
reason
off
why
the
that would
core.
matter.
Because they're making money off selling the course, not trading.
So, I mean, scam is just a subset of fraud, right? And fraud is defined in
Not
relation to some
exactly.
theory of contracts, right? So
No.
that and contract that
No,
would
that's
be.
already not what that is. No.
It's not. Can we get
No,
a definition of scam?
Sure, I can pull up the Merriam-Webster definition, but it has nothing to do with the contract. Here.
Of course it
I'll
does.
pull up.
Is
No,
scam
it does
not a
not.
subset of fraud?
It's not. It has nothing to do with the contract. Hey, what's up, Ostocrat? Sure, let's get the definition of a scam. Here, a dishonest scheme or trick designed to steal money from
Oh,
unsuspecting
steam.
victims.
There we go. Steal, right? That's
Right.
defined in relation to some theory of property, right?
Or money. Yeah.
Yeah, the same thing.
No. Okay.
I mean,
Property and
money
money
is
are
property. You own money,
not all.
right?
Not all properties are money, but anyway.
Yeah, I know, but you own money, so we're talking about the same thing, right?
Oh, it doesn't matter. It's just semantics. We're gonna have like
Yeah.
a. Okay. So when someone is
So
being dishonest by selling you a course because they cannot make money with it, that would be a scam because if they could make money with it, they wouldn't be selling you a course.
be dishonest here. Well, it seems like when it comes to the title transfer, right? Um,
Title
all that's
transfer?
going. Yeah, that's what a contract is, right?
It's not a contract. Where'd I even. Hold up, where'd you get the idea of it's a contract?
You do get for it to be dishonest. You know, for it to be dishonest, right?
I don't think
Like
you're
all
engaging
what
with
you
the
just said, for it to be
conversation.
theft, right?
Okay, you
This
look,
is,
hold up. You're not actually engaging at all.
I'm pretty sure I am.
No, you're not, because you already mentioned contract. Where did contract come up?
Scam is a subset of
No.
fraud, correct?
No.
It's theft by deception. That's the definition of fraud.
That is not what fraud refers to.
Fraud is not theft via deception.
No. It
What's your
goes
definition
deeper
of
than
fraud?
that. Sure, we can Google an exact definition of fraud to give you, because here, I'm just going to give you basic definitions because you need like a definition for everything here. The intentional use or false information to secure unfair or unlawful gain.
How's that not exactly what I just said?
This has nothing to do with the contract. You're mentioning contract
Did I
only.
define it like that?
Yes, you did. See, but like, it's
I
not
said
engaging with it. Hold up.
okay.
How is someone selling
Maybe.
you a course because they can't make? Okay, see, this is the problem. People are too dishonest right there. You can't engage. Can't engage with it. Literally arguing semantics for no reason. I asked them a simple question. Why would someone ever sell your course if they're making money instead of making money and not selling your course? It's that simple. It's that basic.
Ah, shit, man. I'm sorry, bro. I'm the only one requested, right?
There's someone else here, but how old are you?
I'm 20. I don't even disagree with you. I was just
Oh,
trying to
okay,
say
gotcha.
to the
No
people
worries.
in the
Yeah,
comments, 88% of millionaires have some sort of a college degree. Do with that as
right,
you will.
right. Yeah.
My fault, man. I'm not trying to waste your
Oh, no
time.
worries. That's all right. No, no, it's
Go
okay. No
debate these
worries.
guys, man. Big fan.
Thank you. Appreciate it. Yeah, I got some. Yeah, I got someone else here. Edits requesting. Whoop.
Yo,
Hey, how old are you?
19, bro.
All right, go ahead.
All right, look, I have a genuine question, right?
Yes, go ahead.
When I started to learn how to trade futures, yeah,
Yeah.
in early 2025, so I was unprofitable for like 4 to 5 months.
Okay.
And then I found a mentor on YouTube and I
Okay.
enjoyed his content and I liked his advice and I bought his course in May.
Okay.
And after showing up every day and doing what
Okay.
was needed to do,
Yeah.
I eventually started requesting payouts.
Okay.
So, how would you say day trading course is a scam
Okay.
when I
Can
was
you?
alone, not knowing what to do,
Yeah.
I was unprofitable, but then after paying for information,
Yeah.
I was doing way better than before. Like,
Hold up. Question. If they're selling you information, right? Why wouldn't they use that information to make money themselves
bro, the
instead of?
reason people look, the reason traders teach, right? We all know trading is a risk on skill
Okay, but why would a successful trader want to sell it as opposed to just making money themselves?
because you don't trade 24/7. Like most profitable traders, they trade one session,
No,
they're
but
going to
that's
be
not.
trading done within 30 minutes to 1 hour of their day.
That
And then
depends.
they
I mean.
can, huh?
No, no, but that's not the question. It's not about the time. It's just look, someone has a strategy that works. Why would they ever tell someone else instead of just making money themselves and
Because
keeping
you
it to
can make more
themselves?
money from it.
But
Like,
if it no, but if it's a working strategy, you would make much more than what are you talking about? You would make way more than selling it.
but I'm telling you, the proof of concept is there. Like, I was unprofitable and then I became profitable after joining a
Yeah, but
mentorship.
hold up, but can you prove that or you just get lucky?
How do you get lucky?
Because
And you
you have
didn't
to
answer my
well,
question before, my comment that I put,
yeah.
bro.
What was
I
your
said, can you
comment?
post a payout?
A payout from where? A funded account?
Yes.
Funded accounts I don't touch because those are just straight up scams.
They're
Those have
fake, yeah.
negative. Do you know what negative EV is?
EV is expected value, is it?
Yeah, those accounts have a negative expected value. Yeah.
Bro, the ROI on them is insane. What are you
No,
talking
it's
about?
not. The ROI on them is negative.
How?
Because do you know how a funded account works?
Yes, I trade funded accounts every day.
Okay. How much leverage does a funded account give you?
I'm not sure, but when I'm on a
Okay.
50K, I've got like 2K
Okay,
worth
it's
of
not
drawdown.
50K, but you have 2K
Yeah, I know.
drawdown, right?
I
Yeah.
was just about to tell you the buying
Oh,
power is
sorry, go ahead.
50K and the drawdown's 2K. The starting drawdown.
Yeah, but then, okay, so because your drawdown's 2K, meaning you can only lose 2K before it gets liquidated, it's only
Mm.
like a 2K account. And how much money do you put in for that 2K?
No activation fee account, like 110 USD.
Okay. And that's with your eval and everything, about $100 or more.
Yeah, yeah,
Okay. So all in 100, so you get like 100 for 2K. That's a 20x leverage. Okay.
yeah.
Because it's a 2K account. You can get that outside of a funded account and you can keep 100% as opposed to losing 10%. Because here's the thing, anything you do in the stock market without a strategy, you're going to win or lose. You're going to have a zero expected value because everything's priced in. You would agree with that, right?
Yeah.
So if everything's priced in, your expected EV is going to be zero, right?
You could, if you want to say that, yeah.
Well, what do you mean if you want to say that? Is that wrong or
I'm letting you
yeah?
talk. I'm just
No, no, but
listening.
I'm like I'm walking you through the math, right?
Yeah.
Right. If your expected EV is zero, it means long term you're not going to make any money. You're going to win a dollar, you're going to lose a dollar, right?
Mm.
So if they take 10%, let's say you lose a dollar, but then you win a dollar, they take 10% off. You're going to lose 10 cents. You're going to lose 10%, right?
Are you talking about when you take a payout, the profit split?
Yeah. Yeah,
That
that's what I'm talking about.
really isn't like inconsequential to the ROI either way.
No, but it is because I'm telling you what the expected value is. Because if you don't have a strategy, your expected value is zero. They take 10% off the top. You have a negative 10% expected value. Does that kind of make sense, or
No, but it's not even a profit split because, bro, do you trade funded?
no? Because funded accounts have a negative
Have
value.
you ever though?
No, because it's a negative value. Why would I trade something that has a negative value?
So you've never traded the funded.
No, because it's not good. It's you lose money trading a funded.
So do
I'm
you
trying to tell
think
you.
do you
What?
think a new trader? So you're saying, oh, you've got a 20x leverage with that $100, right? And you've only got a
Yes.
2K drawdown. Do you think a new trader is better off having a $2,000 live account?
No, you don't have to have a $2,000 live account. You can put $100 in a live account and get 20x leverage.
Bro, that is not better than a funded account.
No. Yes, leverage wise, it's not any different, but the difference is you don't lose 10%. So with the live account, because you're not losing 10%, you have a zero EV, you
Bro,
don't actually make or lose any money. Whereas the fund account, you'll lose 10%.
you don't know how fundeds work. You have no clue.
That is how funded work. That is literally how it works.
Bro, it's like 10% off the payout amount. If I buy funded for
Yes,
$100,
yes, I
right?
know. That's what I'm telling
Listen,
you. Yes,
Hold on. If I
Yeah.
trade a $100 account, right,
yes,
with a 2K drawdown, I can trade it for
Yes.
2 weeks. I can bring that up to a 5K balance.
yes.
Right?
I got you. Yes.
If I request 2.5K USD, what's the return on that?
Without the payout, or again, return on the 100 would be like
You would
it's a good payout.
the
but-
payout would be around 2350 to 2200 off of a
right?
$100
Yeah.
investment into the account.
Yes.
And if I'm making more money than I am spending on the accounts, how is that not profitable?
Okay, because I'm talking about the EV of it, the expected value. There's something called variance. Do you know what variance means?
No, educate me.
Okay, so variance is basically okay. So there's gonna be a list of variables. You don't know where the stock price is gonna go. It could go up 1%, it could go down 2%, it could go up 5%, right? The odds of it going up or down, like what it moves, that'll be its variance. So because the stock can go up or down X amount, that's the variance basically. So when it comes to your account value, that account value has variance, meaning at any point it can be negative or positive. But your long-term value is zero because you don't have a strategy. Does that make sense?
I have a friend like you, man. It's very interesting. Like all of this yap, it really doesn't make sense to me when
The math, or is this? I mean, I'm
Just-
trying to make it like
no,
I'm trying to
honestly,
make this as like simple for you to understand. Like,
look,
I don't.
maybe if you're looking at it in a different way other than profit trading, bro, to be honest with you, I don't know about all of this stuff, EV and variance and whatnot.
Okay.
The thing is, when you're trading a prop firm,
Yes.
as long as you have a strategy to beat these prop firms and you're making more than you're spending on these accounts, I don't see what the problem is with buying a course to learn how to do this.
Because how can you prove that what you're doing is actual strategy? You're not just getting lucky. How can
Because
you prove that?
majority of people don't make money with it, and
That
it's only a
doesn't tell
certain
me-
majority that
okay,
do make
I-
money with it.
Okay, I get
So
that.
there's
But
obviously something that these people that are making money with it that are doing that the others aren't. It could
Okay.
whether it be your
You-
psychology or your risk management or your actual
Okay,
strategy of
ideas.
making money.
can you make money gambling?
Yes, obviously.
Can you make money spinning a slot machine?
Obviously.
Okay, so if someone's making money spinning a slot machine, does that mean they have a better strategy than someone losing money spinning a slot machine?
That just isn't that's not the same.
It is absolutely
Because
the same.
I
Why
can
is it
tell you
the same?
something, right?
Yeah.
So let's say you're on a funded account and I'm on a funded account.
Okay.
And me and you both rock up to the trading session and we both have a risk plan. Let's say
Alright.
you're planning to risk $250 and I go into the day planning to risk $250, and let's say we have a 1-to-1 risk to reward average, right?
Okay.
And I go into the day and I actually take my one trade and
Okay.
let's say I lose 250 and I'm done for the day.
Okay.
This is a prop firm account, keep that in mind.
Yeah.
And I'm done for the day, I lock my account out, boom, on to the next day.
Okay.
You, however, you go into the day thinking, okay, I'm gonna risk 250, but then you take that loss and you're like, wait, I just lost. Let me take another trade. Let me take another trade, boom, your account's gone.
But that doesn't change the probability of success, though.
No, but the thing is, that's the
What?
difference between the people that make
No,
money
but
from
that
firms.
literally doesn't change your probability. What are you talking about? No, because if this, okay, but here's the part you're forgetting. The past, like say you lost or made money like your trade before, that doesn't impact your next trade.
No, but what I'm telling you is it's based off of the decisions that these people make that are on the prop firms because
Okay, but
some people they
what
can't even
decisions
last.
are they? But okay, but here's my question to you, Edis. What decisions are they making that are like consequential other than just pressing buttons? They're literally just pressing buttons. They don't know what they're doing.
Exactly. That's why there's people that don't make money with prop firms.
No, but are you doing something that has a positive like see, this is why I asked you for EV and it's like if you do something long term, are you making money? Yes or no? Are you making money long term trading?
Yes, and I'm telling
Can
you,
you prove that with numbers? Or are you
numbers
just
wise, bro.
gambling?
Wait, what do you mean gambling?
Like you're literally just betting money and you're getting lucky.
You can't. That's not how it works, though.
That is
It just
literally how
isn't.
you're describing it because you don't really have a strategy.
How do I not have a strategy?
You don't because the reason you don't have a strategy is because you haven't described anything. So thank you for the donut. You haven't described anything so far that would tell me you have any idea of like you understand what you're doing. You're just kind of like saying, "I
And I
make
should just
money."
pause. What were you saying?
No worries. 'Cause all you said up here is like I got payouts, but then you don't know what the EV is or
Well, I know going into a prop firm account, right?
yeah.
I know that for the average payout that I get, I can blow 10 to 15 to 20 accounts before I get that payout.
I
But if you were to
understand that,
go
EV.
onto a live account with
Yeah.
2 grand,
You don't have
that
to do that. No,
person,
but here's the thing, ETs. That same
Mm.
leverage, no, but that same leverage, that 20x leverage you're getting, you can get that with the live account too. You realize that without losing the 10, without doing the 10% payout.
yeah, but you wouldn't be able to make as much money
Yeah,
as
you
you do on
would.
a funded, man.
You
You
absolutely
wouldn't.
no, but if you have the
You don't
same
have
amount,
the
hold up. But ETs, do you know what it means to have the same amount of leverage? Okay.
yes.
Okay, so if you have a
You
hundred
have the same
dollars
amount
with
of buying power as if you were on a 50k
no,
with
because
2k
your 50K is
drawdown.
a 2K drawdown, right? It's a 2K account. It's not a 50K account. You're
Yeah,
paying
but
a
you have the
hundred.
buying power of a 50k account. That's the thing.
No, but you don't. No, hold up. You don't because if it goes down below 2,000, your account gets liquidated. It's only a
Mm.
2K account. It's not. They can put that number $50 million. Oh, they can put it $50 billion. The second it goes down below 2K, your account gets liquidated, right?
Yeah.
Yeah, exactly. So it's not a 50K account. It's only a 2K account. It
Uh-huh.
functions as a 2K account. No, but my point is you can take that same 100, you can find financial derivatives that will give you the same amount of leverage. Your returns, if have a strategy that works, will be the exact same, except you're going to get 10% more that you're not losing on your payout. Is
Bro,
that
you will not make the same amount of money. It's not possible, and you haven't even tried a funded challenge before. That's what I don't understand. How can you
it's a
knock
scam.
something before trying it?
Hold why hold up, but if you know how the math works, you know that funded accounts lose money.
Because more people are unprofitable than profitable.
No, like it's mathematically rigged against you. You're not going to be able to win with the funded account. It's not made for people to win at. Do you realize that?
Well, no
And
shit. That's why British prop firms stay running. Because there's
yes,
rules.
that's my point. So why would anyone want to actually touch that? And if you had a strategy that works, you had a live account, get the same amount of leverage, you would have made a lot more.
Look, personally,
Yeah.
I can't trade a live account. Okay.
Okay, I see. Okay, I get that. Okay, that
Due
makes more
to
sense. Okay.
the only reason is due to religious
Yeah.
reasons. Because on prop
Okay.
firms, it's actually all simulated price.
Right, I know that.
It's similar to the
I get
accounts.
it. I'm assuming
But
you're Muslim and you want to avoid
yeah,
interest.
yeah. But personally,
you.
yes. But
Okay, I got
personally,
you.
like the way I see it with prop firms, there's insane ROI in it. And I think there's someone similar to you. Like he's a bit bigger than you. Obviously, he started like this whole quant thing. That Thomas guy, and he's actually tried funded challenges, and he's even said like, with the correct, there is ways to make money on them.
Okay, but here's my question to you. If there's a way to make money, wouldn't just everyone do it and these funded accounts would go bankrupt? These prop firms?
Everyone does do it. There is people that make a
So
lot of money.
why hasn't so
prop
why
firms,
haven't they
bro.
got wait, hold up. So why haven't these prop firms gone bankrupt if everyone's making money off of them?
No, more people lose money on prop firms than people make money.
No, but if there's strategies that work, wouldn't everyone just use a strategy that works and these prop firms go bankrupt?
But it's not only strategy because not everything's mechanical. You can give a sheet of paper of my model that I trade
Yeah.
to me, and you can give it to someone else. We can both read over it, and I can go trade New York session tonight, and I will trade better than that person. I will do better because it
That
comes
doesn't
down
no hold up,
to
then that's not the same strategy then. That's not the same that's not how models work. You realize those have to be the exact same things, otherwise it's not the wait, hold up. Oh, you're saying you have a way of trading, like you have a model. You have to say like, XYZ. If it's
Yeah.
XYZ, trade this, you make money, right?
Yeah.
So then someone
So
could
you
do the
don't make
exact
money,
same.
you enter a trade and you have a win rate.
That would mean you make money long term doing this, right? Okay. So if you have these XYZ things you just plug in to make money, why wouldn't everyone just do this and these firms go bankrupt?
Bro, the thing is, there's lots of variables to it. If I give you a PDF of just saying, okay, go into the New York session tonight and trade this, you won't be able to trade the same way I do. You don't have,
Okay, then you don't have a
you
strategy.
haven't backtested that
You're just
strategy
going off
either.
but that's not a real strategy then. Your strategy has to be replicable. If you can't replicate, if someone else can't look at what your strategy is and replicate it, that's not a real strategy. You're just going
Well, they
off of
can
like,
if they backtest it.
why would you have to backtest it? The strategy has nothing to do with whether or not you backtest it.
Bro,
What are you
what?
talking
That's like
about?
saying you're gonna
Executing. No, but
that's
if
like
someone,
saying you're gonna go into a
but
cooking
Edie's,
competition
no,
and
that's
never
not.
cook
Hold up.
before, and you're just gonna follow
That's
a
not what
recipe.
that. Yes, that's literally what it is. Yes, if you follow a recipe exactly, it doesn't matter whether or not you cooked before.
Wait,
It's a
so
recipe.
you're not a professional chef, right? If Gordon Ramsay gives you a recipe to his beef Wellington, are you gonna make it as good as his?
If you follow the recipe correctly,
No,
yes, you
bro.
would. Literally, yes. Yes.
No.
Yes, you would. What
No
are you
way,
talking about?
Gordon Ramsay will make it better than you, bro, because he's been doing it for longer and he has more experience doing it.
Hold up. Do you realize there's a difference between a recipe and math, right? We're talking about math.
Bro.
We're not talking about recipes. We're talking about
But
math.
the way you
Oh, no,
brought
hold
it,
up.
you
I got
said
a better
there's
one. Hold up here.
X,
I got
Y,
a
Z.
better.
You said.
Hold up, Edie's. I got a much better example.
Mm.
Have you ever cut wood before, or have you ever worked as a carpenter before?
Yeah.
You've worked as a carpenter before.
Yeah, I know how to use a circular and saw and so whatnot, and a drop saw.
All right. Let's say someone never worked as a carpenter before, and you hand them a ruler, and you say, "Hey, cut a 1/4 inch of wood." Could someone who's never cut wood before, using a ruler, cut a 1/4 inch of wood?
You know he actually can't, you know what?
Why
Because
couldn't someone
if
use
you
a
were to
ruler?
give someone a circular saw, for example, yeah?
I didn't say
This is just-
circular. I didn't say
What
circular.
then? What, like a
A
saw?
hand saw. You give
A
someone a
hand
hand
saw.
saw. Listen. You give someone a hand saw. You hand someone a ruler, and you say, "Hey, cut a 1/4 inch off this wood." Could someone who's never cut wood before do that? Following
You know
the
what's
ruler?
funny? He actually won't do it as good
yes.
as the carpenter. No, he
That's
won't.
not even what I asked. This is a yes or
No.
no question.
No, he won't.
So someone couldn't cut wood with a ruler.
No, the funny part is he
Why?
couldn't. That was actually a bad analogy because you have
Why?
to account for the blade. And someone who has never cut wood before, he won't even know that. So he won't get it exactly mil to mil.
What is it? Is
He
math
actually
not
won't.
real? Do numbers not exist? Just
No,
curious.
because no, I'm being dead ass. The person
do
that has
numbers
never
not
cut wood
exist?
before-
It's just a yes or no. Do numbers exist?
Yes.
So if numbers exist, if let's follow this logic. So if numbers exist, do numbers change? Or okay, one is the same. My one is the same as your one, right?
Yeah.
So why couldn't someone using a ruler cut the same amount of wood as someone else using the same measurement and the same ruler?
Can I explain why? And this is gonna defend my point as well. If this person that has never cut wood before, yeah, compared to the guy who's been cutting wood for 50 years, okay? There's something as small as having to account for the blade when you're cutting wood. That's someone who has never cut wood before, he actually won't know that. You have to account for the blade when you're cutting something. It's about 1 millimeter. So he wouldn't get it mil to mil perfect. And that's because he's never cut wood before. But if he was cutting wood for years, like for example, if you give me something and you say cut this at 200 mil, I know that I have to account for the blade when I'm cutting. And you don't cut on the line that's measured with the ruler. So I would be able to
So
cut a
there's
couple.
variables not included in your strategy, is what you're saying.
There is
you don't-
variables like
But
There
there's
is
variables
variables.
not. But no, hold up. But you're saying there's missing variables from your strategy. That's what you're saying.
yeah, well, I'm saying there's variables as in someone backtesting my strategy or just doing it for a while or journaling
But if your
it.
strategy works, why would someone else need to backtest it if it's already working?
Because
it
if I
works.
give you my strategy right now, you won't be able to trade it. What do you mean, bro? Like if
Hold up,
you've never cooked a
hold
steak
up, hold up. Do you know what your strategy is, or could you describe your strategy in any way? You don't have to say exactly what it is, but
it's
what is it? Do you look at charts?
it's
You read
with
charts
New
or-
York session, right?
What?
So I trade the New York session, right?
Okay.
And it's basically off of market open to a certain time.
Yeah.
It's a reversal or a continuation based on what happens at draws. And you know what draws are, highs and lows.
Okay.
Okay, and I
Alright.
have like a
So
obviously a
serious.
whole. It's not really nothing special or magic either. It's all free on YouTube. That's the thing.
Okay.
And
It's
I
all
have
free on
like a
YouTube,
whole
right?
PDF of explaining the strategy in depth. I don't want to bore you or bore anyone, but I have a full PDF on Notion, like a template.
So you
And
just go off of what the chart is, like it goes up and then you're like bet if it's gonna go down or
so it's the funny
like
thing. You're not really thinking it, bro.
I
Educated.
don't think you understand what a strategy is.
I do, bro. What are you talking about?
You haven't described the strategy, or you're just looking at charts and it moves this way and it moves that way. That doesn't really tell me anything.
If you want, I can read it.
No, but you do
Just
realize like all you're describing is the way a price moves. You're not describing what's gonna happen next.
wait. Look, but you won't understand these concepts and whatnot. But I'll read it anyways. So what I have written here, this is my actual strategy. Going into the day, this is what I say to myself. So I
Okay.
say, I want to
Right.
understand what 930 has done and what we were doing at draws when they are met. Identify manipulation. Are we forming a reversal or are we displacing past draws and forming continuation? So it's not even predicting. It's reacting and waiting for price to do what it wants to do. When price meets a draw, we can do one or two things.
All right.
Manipulate it, create an order block and displace out of it. If it's external manipulation, price can come back to the low/high, create it to internally manipulate, and then reverse.
Did you say external or internal manipulation?
Yes.
How would you tell that?
External would be at like the high or low of a range, and internal is within the range. These are highs and lows. External is at the top
Wait,
or bottom
highs
of the
and
range.
lows of what? I'm sorry, like highs and lows within like that, like what time frame?
This is all based off ICT concepts. It's pretty basic.
That
Look,
doesn't tell me what the highs and lows are. Like high and low of the day, high and low of 10 minutes,
based off
high
a
and
range.
low
So
of
let's say it's a 15-minute range, for example, yeah, or a 30
okay,
minute
so
range.
15. Okay, so you're going 15 or 30 minutes here.
For example, what do you want me? What do you want it to be? Like, it's
What's your
very.
strategy going off of 30 or 15 minutes? Like you're saying highs and lows.
I tried on the market.
What
Remember
interval?
that JDV trades guy was in here? I learned from the same guy that he did. I tried on
Yeah,
the
but
1 minute.
that doesn't really answer my
Well, it's very,
question.
very variable and it's based on preference. I can mark this as a range right now, and I can mark something else as a range. Like, say, for example, from the 3 a.m.
What's
candle.
when you're saying yeah, I get it, but like what's your interval?
Bro, let's say, for example, it's 3
Okay.
a.m. to
Yeah.
3:30 a.m.
Okay.
And then I would find the low of that price range and the high of that price range and mark that as a range.
Okay.
You
Okay.
see what I mean?
So it's arbitrary.
Explain that.
What arbitrary means?
Yeah.
Up to your discretion.
Yeah.
Like there's no set, there's no objectivity to it. It's just subjective. Like you sit there, you look at a random time range, and you say, "Yep, we're gonna take this time range and use it." That's
Well,
discretionary. I mean, I guess yeah, discretionary. You know what discretionary means, right?
if yeah, of course. If
Okay,
9:30
same thing
sets
is
price in one way, and I wait for a certain time later on after the 5 and 15 minutes have closed at 35, 40, and 45, and if
okay.
we have a range, then I can mark a range from 9:30 to 9:45, for example. Like, I
Okay.
want to tell you something else too. This is like over hours and hours and hours of like studying that I've done of lectures from the mentor that I learned from, right?
That
So it's
doesn't mean
pretty hard
anything.
to
That literally
explain
means
all.
nothing.
What do you mean?
It means nothing.
I'm
What
saying
you
it's
just
really
said means absolutely nothing.
I'm saying it's really hard for me to explain it in like 30 seconds right now is my point.
Okay, but it doesn't seem like you have much other than there's a high and a low, and then I just determine it's gonna move this way without having much in the way of like why, you know.
No, but there's bro, if you had known the concepts I was talking about and learned from the same person I did, you would understand what I'm talking about.
But you haven't learned anything.
Exactly, because I'm not a teacher. That's another thing
What?
too.
No, but like my
Any
point is you haven't learned anything that's real.
What do you mean anything that's real? If I'm trading prop firms with it and I'm making money from it, how does that make sense?
If you actually learned like finance, you would never touch a prop firm in your life.
Oh my days.
The math is what do you okay, but here's the why I'm saying you haven't learned anything of substance is because all you've described so far is charts. You haven't described like anything having to do with those charts other than like high, low. You just pick whatever time and Maybe it's internal. You're making up terms that don't even make sense.
It's not maybe it's internal. Like internal and external manipulation, they're actually thing. They
Yeah,
actually have a description behind it.
but it's not like a real description.
Based off of ICT concepts and their theory.
ICT concepts are not real, though. That's the thing. What you're describing is not real. It's just
What I
made
just
up by
said to you-
someone. What?
What I just said to you is based off of ICT concepts, which is theory.
Yeah, ICT concepts are not real. It's not theory, though. No, hold up.
It's theory.
You know what theory is, or was theory is described as, or?
The way I would look at it is theory is something that is not 100% proven, but you can use it.
No, theory is something that, while not 100% proven, it hasn't been disproven yet.
That's what I just said, and it hasn't been disproven.
ICT has been disproven. There's literally no evidence for what he's describing, or ICT, whoever it is, like what they're describing as having any sort of substance to it.
Are you looking at other people's words, or have you actually tried to experience to learn it yourself?
I'm talking to you, and you're not able to actually explain anything. That's what it comes down to.
No,
You're
but I'm
making
saying
up terms. Like you just said a bunch of made up terms that don't have anything to do with finance or trading even. Like people who are legit traders, they don't use any of the terms that you're saying. Maybe reversal, maybe, but they don't say like internal, external manipulation.
It would just be made in different terms. We all know this too in the whole trading space. Everything is repackaged. You know that. Concepts, like they're all just seen in different ways. Like there is ICT concepts that I use. Yeah, for example, PXL and PXH. It means X equals time frame. So it's previous time frame low and previous time frame high. Okay, but there is a whole group of different traders that trade supply and demand, and it's literally
Supply and demand of what?
it's a strategy, right?
Yeah,
It's
okay,
supply
sure.
and demand, and ICT concepts, it's called PXL and PXH. It's literally like the exact same.
ICT concepts aren't real. It's all just made up terms.
I'm saying what I'm trying to explain to you is all of this shit is very packaged. It doesn't really matter. I really don't like
No,
this
but
whole.
what I'm trying to explain to you is, yeah, maybe these are repackaged, but they're personal terms. They're not like actual terms to describe real things. What
How
you're describing, what you're saying.
it has definition behind it, and I can spot it on the chart for you.
Spotted on the chart. So you
Yeah.
do chart reading?
Of course,
Okay, cool. So when you read the chart, what numbers are you looking at?
numbers, as in, do you mean actual price or?
The chart. The chart
I
is
don't
made up
know.
of numbers, right?
I didn't trade order for nothing. I trade purely based off of candlesticks.
But those candlesticks are based on numbers of like price movement, right?
Uh-huh.
Yeah. So my question is, price goes up or down, it moves in a certain direction. Say price goes down 10%, it goes up maybe say 1% or something. Like what are you basing, like what numbers are you going off of? Because going off of candlesticks just means you're looking at a picture and you go off the picture. But then I'm asking you, like, because that picture is made up of numbers. It's just a display of numbers. What are the numbers that you're looking at that tell you when to trade?
Look, so I can give you an example, right?
Yeah.
Basically, what I see a lot of ICT traders, they trade off of draws and liquidities. So basically, it's a level, it's a high or low. You can be on the 5 minute, 15 minute. It's a draw, all right? It's a high or low in the market.
Okay.
And when that level is met, based off of signatures at that level, that lets them form a narrative and their
What do you mean,
bias
signatures?
signatures. So there's signatures on the low time frame, as like for
What
example,
do you
the
mean by
one-
signatures?
it would be PD arrays, like certain patterns that you've seen before. And the thing is, when you backtest a strategy like this for so long,
Okay.
know this.
How long have you how long have you back tested it for?
I can log into my FX replay 1 sec.
Or just how many years? You don't have to go that far, but
I don't know exactly, but it does. I can check right now. It does have the how
like
much.
how many years roughly?
I would say I've backtested 2 years of data at the least.
That is nowhere near enough.
But
It's
then,
okay, look, yeah, sorry, go ahead.
bro, don't forget I've been trading just for around 10 to 11 months.
I got you, but I'm just saying, like, if you're gonna backtest something, you want to try closer to 10 to 20, 30 years of data. But don't worry, I get it. You backtest whatever you had. I get it.
Price
I get
that
it.
isn't really relevant to the way I trade. Like for example, we trade based off of speed and efficiency, right? If you go back to
Wait, hold on. What do you mean by speed and efficiency?
so when a candle has lots of volume in it, and
By
speed.
how much? Wait, volume by how much? What percent of the volume is lost that you would trade it?
Well, I could tell you that, for example, based off of NQ, a 5-point candle is. Oh my God! Can you please get AA Bands on here?
Yeah, Bands, I talked to him. He does not know what he's doing. He sells like I think a $4,000 mentoring course. He doesn't really know how to trade.
Right,
I
AI
mean,
Bands
maybe he does,
is the
but
goat. Anyways,
hold up, it is. You know, AI Bands like he doesn't know like Finance 101. I asked him
look,
about it, but
look.
like what?
I know AA Bands has a lot of hate in the whole like
It's not.
community.
Look, Edie's. It's not. Look, that's not my issue with him. My issue with him is he doesn't know what he's talking about, and he's trying to sell people on it. That's
He
my
knows how to
issue.
make money though.
He has literally no evidence that. Do you know what beta is or alpha?
Oh my days! You know what a payout is, bro?
Do you do you know what alpha is? This is related to your payout, by the way.
Nah, I know. It's I have a quant friend who talks about it. It's like an actual edge. Yeah.
Alpha, but alpha is your payout. I'm asking you, like when you talk alpha, it literally have to do with your payout. Do you know what your alpha is?
Edge? Is that what it is?
Not edge. I mean, I guess in a way, yeah, sure, edge, but
There's
like
a lot of terms that I don't use, so you can't really expect me to know, but you can educate me.
what? I mean, sure. Okay. Here's what I say. The first thing, what you should do is go take like a finance 101, very basic stuff, like stock market 101. Take a free YouTube, plenty of great stuff, like Patrick Boyle on finance. He's great. Look into like the simple stuff. But I was just gonna say this. What alpha is your returns over your benchmark. So basically, take for example the S&P. S&P will do about 8 to 11% in a year. If you made 12% or 13%, and the S&P is your benchmark, you make about like 1 to 2% alpha. Does that make sense?
Yeah, so like more of an edge over than something I guess
Over your benchmark. Yeah.
like you can just get that anyway, is what you're trying to say?
What I'm saying is alpha is what you're going after. It's your returns over your benchmark, meaning that let's say, your benchmark's 9%, you make 10%, that's 1%
You're saying the
alpha.
benchmark would be the bare minimum or something like the S&P.
Yes, because if you're not meeting your benchmark, right? Let's say S&P did 10%, but you did 7%. It doesn't make sense for you to trade because you're losing out 3%. It would be better just to invest, get 10%, and not lose the 3% that you could have gotten, right? Does that make sense?
Yeah.
Yeah. So that's why So when I ask you like, what's your alpha? I'm asking you like, are you beating your benchmark? Because that has to do with your payout. Because if your payout's not going past your benchmark, what's the point of you trading? Because you would make more money just investing. Does that make sense?
Yeah, look, I'll say something about prop firm trading, yeah? I've never traded a live account for more than a year, so I can't tell you that I'll
No
be
worries.
profitable on a live account over a year time span, right? Because I've never done it before. But
got
I
you.
know
Okay.
with the strategy that I have and risk management wise,
Yeah.
all of that wise, I can make money, my ROI on prop firms. And a lot of other people can too. Because the way prop firms work, right? You haven't traded it before, so I'll actually tell you.
I know how they work, but
Basically, you can take your money while you're up on the month, for example, and you can request money, but you can still end up losing all of your balance on that account the day after. And ROI wise, income versus outcome, you're still profitable on the month. But you might not have been a
okay.
profitable trader for the month.
Okay.
Money wise, you do make money. That's another thing that a lot of people have to understand about
But
profit.
hold up. Okay, but do you know what the EV of a prop firm is? Expected value.
Bro, look, I might be uneducated when it comes to that.
No,
Yeah.
but like has to do no, but this has to do exactly with what you're saying. Because when you say EV, right? Or actually, when you say, "Oh, I'm getting a positive payout and all this stuff," what you're saying is you have a positive EV, you're making money. Without a positive EV, you don't make money. Does that make sense?
But what are you saying? Positive EV, you do make money. I just explained to you how people make
Expected
money.
value. What's your expected value
I
of doing this thing?
I don't know.
No, but you're saying you have a positive expected value. I'm not saying exactly, but I'm just saying you do trading. You're saying you can do these funded accounts and you have a positive expected value. You expect to make money, right?
Yeah.
Right, exactly. That's what I'm saying. But what I'm trying to tell you is these accounts don't have a positive expected value. All you're experiencing is positive variance, meaning that you flipping, coin, whatever it is, and it's in your favor. That's what made you the money. You don't actually have a positive edge. Like if you keep doing what you're doing, eventually over time you will lose money because the expected value of it is negative. Does that make sense? Or
If that was true and certain people don't have a edge and actually have a system that works, why do some people request payouts and some people don't?
It doesn't make any sense about what people request
It
or
does
not. I'm
make
talking.
I'm
I'm
telling
thinking
you,
about
why is,
I'm telling you the probability of making money.
and if you're saying, oh, like it's lucky, then it wouldn't be only 3% of people request payouts.
What?
It would be a lot higher than that if it was based off luck. There is systems and there is edges that actually cause you to request payouts on prop firms. The fact that you can't agree with that is insane.
What? Agree that there is like strategies that work.
There is systems and people do have edges that allow them to make money on prop firms.
Hold up, but okay, but do you know how a prop firm makes its money?
Of course, by people losing their money.
Right. Do you know how bad look at the eval? What do you have to do to pass an eval?
I'll give you the most basic example.
Yeah,
On a
yeah.
50K, you have to make 3K before you lose 2K.
Okay. So basically, you have to go up in a direction, say 75% opposed to like 50%, right? Does that make
Mm.
sense? You
Mm.
can't lose more than 50%, but you have to make more than 75%.
Yeah.
So that would put you at a disadvantage, huge disadvantage, by the way. That means you're 50% more likely to lose than win.
I
Just
guess,
off
but
rip.
if I've got around a 70% win rate with like a 1.5 risk reward, you can easily pass that account in 2 days.
Okay, but what's your risk adjusted return?
Are you saying my average risk reward?
No, risk adjusted, risk adjusted.
What does that mean?
Like your Sharpe ratio.
Like the max I could lose on a day?
Not like the max you could lose on a day, but when you do a trade, right? There's like a level of variance you experience. Like, what's the level of risk that you're taking on per that one trade? Is what I'm asking you. Like, what's
It
the
varies.
variance
On an
of it?
eval, I would try to pass it as quick as possible. I would try to pass it in 2 days. So I would risk around 1,000 to 1.5. But if I were on a express account, the risk is around 200 to 300, and that gives you like 7 trades in a row before you blow the account.
But no, but like, what's the variance of what you're trading? Is my question. Like, what's the variance of it? Like, what's the likelihood that you'll be in versus you'll lose that one trade, based on what you're trading? I don't think you looked at that. And it's okay. It's okay,
I
but
can't really explain it to you because you don't understand what I trade. I tried explaining to you, and you think I'm speaking gibberish.
no, it's not. It's not. I think you're speaking gibberish. I think you're trying to explain something, but then you're not. But you're not like fully informed. Like you're almost there, but then you're missing a piece.
Look, what I don't understand, which is not fair, yeah, I would say.
Mhm.
When these terms that come up that I don't even understand, I'm admitting I don't know what they mean, and I'm
And
I'm
it's
telling
okay.
you what they mean.
Yeah, and
But
that's
then
okay.
when it comes to you speaking, you're trying to tell everyone that day trading is a scam, courses are a scam. Bro, you haven't even dared to try an eval. You haven't even
Hold
dared
up.
to have a
Like
look
I
at
explained to you what the math is. The math is against you. You're literally losing money for no reason. You
bro.
can make more money just doing live trading. Way more. Like significantly more. Like it's not even close.
Do you trade?
Yeah, I've traded, yes.
Like, do you trade currently? Do you have a live account?
Yeah, I have a live account. Yeah.
That's interesting, man.
Yeah. But you have to realize like the reason that you don't touch those things is because you have to look at you have a prop firm, right? To pass your eval, you already like your example, right? You 3K you win, 2K you lose, right? So that's
Uh-huh.
about you have to get 3. You have to win 3% versus lose 2%, right? Lose 2%, you're out, win 3%, you're in. So that would mean you're 50% more likely to lose than win, right?
Well, you could say that, but like I said, it varies because it depends on.
Oh, oh, you muted yourself. Oh,
Like I said, it
yeah.
depends though because it always varies on the trader, and you can't go straight
No, I'm
just
not
off a
saying for the
probability.
trader. No, but I'm giving you this. I'm looking at the probability of it because I don't know what the trader is doing. Because if there's a trader making money, why would they use a prop account versus a live account? Why wouldn't you just keep 100% of everything you're making?
Well, look, the risk on with a prop firm account,
Yeah.
you're barely losing anything, right? There is scenarios where people that go into trading, they go into trading and they open up a $1,000 live account and they lose it. And let's say they
You
throw
can
that
get the
money.
but EDs, you can get the same level of leverage. But you can get
I
that
know, but this is
$100 to act like $1,000 without
I know,
putting a
but these
thousand.
people,
Yeah.
they do open $1,000 live accounts and they lose it within the day, right?
I
Would
don't
you
think they
rather that
literally said.
person? Would you rather that person trade $1,000 live account and lose it within the day, or go
It
through
is.
10 evaluations over a
It
few
is.
months and you actually learn.
It is. The $100 live account is the same as the $100 prop firm account, except they don't take 10% off the top. You can get a $100 live account, get your 10x leverage that you're talking about. You can get the same thing except not lose 10% off the top. This is what I've been trying to tell you.
So, but you won't be able to risk the same amount of money in the trade that you can on a funded.
It would be the same thing. No, it's the same. Same $100. Literally
What do
same
you trade?
$100.
What do you trade?
Options. You can trade options. You can get a 10x
Bro,
leverage with options.
man, you wouldn't be able to, bro. You wouldn't be able to trade a fucking live account with 10x leverage and
You can do that with an option. The options will literally give you leverage.
NQ minis. Bro, I'm talking about futures. You know, majority of your audience that joins and like they say, "Oh, this guy's an idiot," blah blah blah. They're all futures traders, you know, right?
Yeah,
It's like,
I know because futures give you leverage. Yeah, that's why you use futures. You can, okay, but do you know what a future provides that an option also provides? It's just the same. It's just leverage.
bro, options is like OD gambling, bro. Like insane gambling.
What do you think you're doing? Yes, you're gambling too. What do you think you're doing?
Bro, but like options, bro. A lot of people lose way more money in that than they do with futures, and you know that too. I've heard fucking insane stories.
You know why? There's
Why?
more people because there's more options trading than anything else. That's why.
No,
It's
but
not
like,
because
everyone, and another thing too, bro. It's like everyone's story, bro. They come into trading, they just lose a fuck ton of money in options, and they get into futures and they start making money.
futures are okay. Let's just
Wait, Eddie, didn't you say you risk like at least one mini contract per trade, like in NQ?
Yeah, wrap it up. It's just coping to practice his passion. What you say, Scott?
I said, didn't you say that you risk
Yeah.
like at least, or your lot size is one mini contract per trade on NQ?
Well, it depends on the trade because you can have one mini, but your risk can be $100. It depends on your trade.
So, like with an eval, would you ever, like you were saying with like that 2K drawdown,
yeah. It was a
would
2
you
to
take
3.
would you take
Yeah.
like a NQ mini?
It depends on the setup. Like, if I need to, it depends on your stop loss. So, if your stop loss is going to be around 10 points, for example, right? And with one mini, that's $200. But let's say you want to risk $1,000. For example, you would enter with 5 minis for a 10-point stop loss. That's just a very thing example.
Yeah. So, like, you would theoretically, I mean, in that case, you would risk like 50% of your account on
Right.
one trade, basically.
For an eval, yeah, I would, because I can win 2 trades in a row somewhat
And the
easily.
NQ is also fluctuating 10 points like every 30 seconds, right?
That was a very thing example to keep the max. Usually my stop loss size is like 30 to 35.
35 points.
Yeah, 30 to 35, but it depends on price. So it could also be 50. It
You're
just
risking
depends.
your entire account per trade.
No, it depends on prices conditions. So if it's going to be around the 30-point stop loss, I would probably have around 12 micros.
So do you determine that through like ATR?
ATR? Well, look, I don't know these terms because I trade a very different way. I just base it off of experience and what I've seen before. Like, let's say, for example, I can tell you that when I trade London session, my stop losses are usually around 10 to 15 points. But in New York session, they can range from 30 to 50. This is just what I know from what I've done. And
Right.
how can you respect that?
Well, because it seems like you were criticizing him about trading options where like it seems like you're actually like participating in equivalent to roulette, but like worse odds than
with
like,
significantly worse odds. Because if you
Like
think
a
about it,
casino.
if your strategy has an expected value of 0, which would be good for you because it doesn't seem like you have a strategy that is based on anything other than kind of your own discretion. You have a 0 expected EV and they take 10% off the top. It's a negative 10% EV for these funded accounts.
But the thing is, there is a lot of people, not a lot, majority of people lose money, obviously. Income versus outcome, they make more money with prop firms than they lose with prop firms.
Because of
Wait,
variance.
what do you who's making more money in prop firms than losing?
Yeah, what are you talking
The
about?
percentage of profitable traders on top of trading.
I mean, look, you can get 100 people to pick 100 different stocks. One of those stocks is going to do better than everyone else. It doesn't mean that person picking a random stock is some genius. It just means they got lucky. There's
The
variance in
fact of
all
the matter,
things.
like I was curious. Like I heard about
Yeah.
the religious sort of contentions you had, but
Oh, I see. Yeah, I guess it's a
the
religious
fact
contention.
the
makes
fact of the
sense, yeah.
matter though is, I'm not sure how you're differentiating between that and a live account, and I'm actually curious about
It's
that.
because
Like,
prop firms are,
and not trying to.
prop firms are demo
But
accounts.
the point being is prop firms are like, say you did have a well vetted strategy that produced significant alpha. We'll just say prop firms are only going to like decrease that. I mean, there can be positive expected value with a prop firm, but there would be more expected value by definition, or not by definition, by way of mathematics, if you just had a live account.
Right.
That's why prop firms are a scam.
Yeah, well, look, for me, it's a religion thing, and the
Then why
main
don't you-
reason why prop firms is because it's simulated.
But you could have just started that instead of trying to make an argument that somehow like these funded
I
accounts are
told you
like,
that ages ago. This Scott guy just.
I don't understand though. You're still risking like a certain amount of equity, right? Like just
Yeah,
money
but
you put in.
it's not actually in the market. It's a transaction between the prop firm and me. Like,
But it's in the market of that prop firm. Like it might be a smaller, a substantially smaller market, like exponentially so, but you're still in a market.
bro, the actual trading wise, it's demo accounts. Like, there's literally
Right. It's their own little black box. I agree, but you're still participating in a market.
Well, what's your point? There's no interest involved.
Well, why would there be interest involved with like a live account per se?
no, because that's what's against his
Really?
religion. Because he's Muslim, like interest is forbidden. I get that part. Okay, I understand that
It's
part.
irrelevant, anyways. That's not even the point that Tiki's trying to make, to be fair. So,
I mean, I'm making the mathematical argument because you have to understand with these prop firms, if you have a 0 EV and they take 10% off the top, that's a negative 10% EV. Like, I don't know if the math could be any more simple than that. And you have terrible odds. Like you have and you're in the case that you described, you're 50% more likely to lose out on your eval versus
and then
winning.
and then if you blow free evals and you spend 300 USD and you request a 1.5 payout, is that not making more money than you spent?
I don't
Because
think
you
you
have to-
get the math though.
The fact that you have to pass an eval makes your odds astronomically
Of course.
lower than
But
being profitable with a
If
live account.
if I buy free evaluations, right, 100 USD each, and you're saying, oh, the odds are against you, but then I eventually pass the account, and then I adjust my risk, so the possibility of me making money is much higher because instead of giving myself 2 trades, I now have like an 8 trade buffer,
But
and I build
No,
that
but the
balance
point
and
is,
take a payout.
that same money you paid to buy those 3 evaluations, you would have a greater chance at making money on
right,
top
you
of
would make
that
so much
if
more.
you
It's
put it
not
in a
even-
live account rather than
Yeah.
paying for those evaluations.
Right, and you don't seem to like have like a legitimate strategy. You're just saying like, "Oh, I do this to pass my evals," but you haven't been able to like describe a strategy.
Bro, like I said,
That's
you
real.
will understand it, but there's people that are in the chat, if they're in here, I saw one of my friends before, and he trades the same model I do because he learned from the same person.
But you don't have a model that works. You're just trading off of pictures.
So
You're literally pointing somewhere and you're saying it's a line this way, it's going to move in this direction.
no,
But then
it's
when I
not.
ask you like what are the inputs, you don't
If you
know.
want to dumb it down like caveman wise, it would be there's a line here, what happens at the line? It's not there's a line here.
But it's
that.
but I'm asking you what inputs go into that line.
I could explain to you like the confluences I see on, for example, the low time frame, but you wouldn't understand it because you haven't studied it. It doesn't make sense. The same way when
You're making up terms to describe something that you're not using real terms. You're using made up terms. You're like, you don't understand my made up terms I use. But when I ask you about real finance terms that are used by hedge funds and quant firms and market makers like alpha and beta, you would be lost.
well, the thing is, I haven't learned what you've learned, and
Well,
you
no,
have
what
the
I've
problem
learned
is
is
your model.
finance.
If you were to
That's the
back
thing,
test
though.
your model,
Mm.
no, but here's the problem. If you were to back test your model, it would either be 0, and again, I'm going off a limb here, unless you. It seems like you were saying that you learned your strategy from someone else. So I feel like this is a very fair assumption that if you codified your model, which it seems like maybe you've done, and you back tested that, it would either have 0 expected value, which is probably the case, but even if it had some expected value, and then you adjusted that for market risk, you would be only having expected value because of market drift. Does that make sense? Because the markets, so you would be better off, and probably if you risk adjusted that once again,
Yeah.
you'd be better off just investing in the S&P rather than
Plus, you lose out on money you could have
participating
made
in
just
the
working.
day trading.
Like the time invested is also not worth it, objectively speaking, because you're gonna make probably more. You'll make much more just investing your money in the stock market and having a job instead of just trying to do this like day trader and not have a job and basically
No, I don't.
You're-
I don't believe in. I don't believe in. Oh, I'm gonna day trade and not have a job. If you want to do something like this, you have to have a job.
no, but like how many hours do you spend day trading as a day or a week?
Look, I'm not gonna lie. When I was first learning how to
Yeah.
trade and everything was, I spent a lot of hours. Right, like I
Right.
was for months, like 4 to 5 to 6 hours a day. But now that I've actually established an edge and I have something I follow, I just trade.
How do you have what's your edge? What's percentage is your edge?
I was reading it before too, but you didn't understand.
No, but what's your percentage edge? Just the number. Like, what's your number of like what's the percentage of that? Just give me the number.
The number,
Yes. Give me your number. Yes.
bro.
How do you quantify your edge?
Yeah.
What I mean when I'm saying edge is I have my edge toward the market, as in what I'm telling you is I don't study.
But hold up. But do you know what an edge means, right? It means you have like a certain percent you will make long term. Like, how much will you make long term? Like, what's your,
Outside
yeah,
of market risk.
Yeah.
Well, look, it's very hard to answer that when you're someone who trades a profit and not a live account, for example, because I'm going through multiple accounts and it's not all data.
Yeah, but
on one.
but
That's
it
another-
even the prop firm catalogs all
Yeah.
your wins and losses, right? So you could
No,
calculate
after the account's
your-
going, it's gone.
well, that's
Right.
not good. If you're paying them, they
Yes,
should probably at least give you a report
Yeah.
or something.
I track a journal myself on Notion, but I don't have statistics behind it.
So how do you know you
That's
have
the
an
problem.
edge?
You don't actually know you have an edge. Yeah.
Yeah.
It's like a psychological journal and the
What?
pictures of the trades and based off the
Did you-
concepts and risk reward.
But edge is a number. That's the thing. But you don't have that number that
Alright,
tells
then I
you
might
that.
have. Alright, then let's say I used the word wrong because you can say I did. What I meant is now that I'm not learning trading anymore,
Okay.
and I'm just trading now, and I just journal after I'm done trading. It takes me half an hour at the end of my day.
Okay.
I'm in Australia, so I trade very late. But
All right.
yeah, it just takes half an hour out of my day. So it's not like it's life, like it's shifting my life. And something I don't believe in is people like, oh, I'm gonna day trade. I'm not gonna work a job. Blah blah blah. That's wrong.
No, but that's not my point. My point is
A
like
lot of people do
you're
that.
investing time into something that would be better off just investing and working a job, and you would make so much more money that way.
And,
But
we're
like-
talking about the most like you were mentioning
Yeah.
that you trade the NQ. Like you're talking about one of the most competitive. Like you got to understand, futures are the most liquid. Outside forex might have it beat
No, I've heard
slightly,
this a
but
lot.
you're talking about the most competitive market in the world. So like
Yeah.
you can't just have another job and also expect to like because your
Okay.
other job is also competing in another market.
But you have
So
to
you can't
remember.
expect to like compete in the most competitive market
You have to
and somehow
remember.
be successful while doing
Yeah, you
something
can
else.
join Recon Data Trades.
You have to remember. You could argue that me on a live account for a year, I wouldn't be profitable 1 year in a row, right? You could argue that. But my
Hey,
point
Eddie,
is,
I'm sorry, Eddie. Eddie, you're not defending yourself really good. I just got to let that known be out there.
Well,
Sorry to jump in
know
here,
that,
guys.
but no worries. Recon, how old are you?
I'm 33 years old, man.
Oh,
I don't know.
okay.
Yeah, I'm 33 years old. I've been doing this going on 7 years. No, I really wanted to attack some valid points in regards because I know you guys are. It seems like you guys are option traders. I'm in ICT/fractal traders, not fractal indicators. Fractals made by Quant Russell Pate. Obviously the quant software that he created back in '95. How you guys view prop firms? I think it's like you guys got to understand. There's people in this world who don't make certain amount of money, right? So we got to understand discretion in regards to people's income. Okay,
You're
so
talking about like prop firms give you leverage. That's what you're saying.
yes, because you
But
guys
then
got
you
to
can get the same leverage with options and keep 100% of your
Okay.
payout or your
I-
win or whatever. Yeah.
Okay, I get you that point, but let me finish. I get
Okay,
you on that
sorry.
point. I get you on that point, right? You are 100% correct, right? But we're trying to compare two, let's say Joe Smo number 1 and Joe Smo number 2. Joe Smo number 1 works at Dunkin' Donuts. He probably makes $500 a week. He wants to get into trading. Joe Show number 2, he's well off. He's probably got, he's probably a trust fund baby, makes good money. He's got probably 5 or 10 grand in the bank from his
I
parents or
don't think
something.
you
So
got my point.
you get what I'm trying to say. But
No, but you didn't get my point.
I
My
understand
point
your
is you
point.
can risk
I'm
the
Josh
same
Fair
am-
number one.
Look. I
you
understand
can
your
risk
point.
the same amount of money though. That's my the thing is you can risk the same amount of money, get the same leverage as you with the prop account without it eating 10%. That's what I'm saying. Joe
That
Schmo can put $100 in a live account and get the same thing as putting $100 in a funded account, except the funded account will take 10%. That's what I'm saying. That like you're
I
talking
get
about
you
like
on that
yeah
point. I get you
yeah.
on that point, right? I get you on that point. But let's understand the point of actual true trading and risking the actual 1 to 2% per trade. If you're going into an options trade with $100, aren't you risking that whole $100? I don't see how that's valid.
Yeah, but
That's like,
Recon, if your upside, like your return itself, is already diminished,
You don't have to
okay,
hold up,
okay.
hold up.
Let's
No, no, but
let's not talk about the
wait,
return. Let's
Recon.
talk about what you guys were talking about in regards to risk. If you're risking that $100 and
Better.
you're risking that full $100
You
on
don't
that
have
one
to
trade.
hold up. No, but Recon, you don't have to bet your entire portfolio on the option.
Okay,
You
but
do
let's be
realize that,
realistic. What
right?
option trade are you not? What option trade are you getting roughly
first of all,
under
I don't trade.
$100?
I've never really seriously traded options other
I
than
have.
hedging out like equity. Yeah, I'm sure the host is much more
You don't have to
knowledgeable.
bet. You can
That
get options for less than $100. That
and
will give
Yeah.
you
Recon,
as
just like I don't really
ton of
like to
leverage.
share my background, but
Okay.
I was in like a nice like cushy position where I've had a good sort of career within finance and never had been like making money off publicly traded markets.
Yeah.
But a live futures account is really what like bolstered my trajectory into full time being in the derivative space.
Yeah.
So I mean, even from like anecdotally, like a live, I promise you, a live futures account, if you actually have a valid strategy, is going to outpace any sort of prop firm because it doesn't just like it's not just the risk, it's not just the return, it's the combination of both that determines like your ultimate sort of edge on the market. And so, like if your upside is already if it's automatically diminished by 10%, your risk adjusted return / your probability of being quote unquote profitable is diminished. So you have a higher probability of being profitable if you're not using a prop firm.
You do.
Significantly higher.
Okay, yes. I wouldn't say significantly higher because if you have a strategy that's 51% profitable, even with the prop firm, you're destined for a payout. As long as you stay consistent. I've been
But
doing
you
this
don't
7
get
years too.
compounding. But you don't get compounding.
Yes, you do. You don't get compounding, but you can once you get pushed to live because there's other rules that get set in place. Now, prop firms in the beginning, they're set to make you fail. We all understand that. But I think how you guys are targeting prop firms, like, bro, I've made a lot of money with prop firms. I am very profitable. I do not have a 9 to 5. I haven't worked a 9 to 5 in over 5 years.
Do you have a strategy that okay? So do you have an edge?
Okay, since you guys want to say what's your edge over the long term and what's your profitability over the market and so on and so forth, my edge is what? My entry model, my ICT strategy, my fractal software that I use to trade. Like it's just like
That
yes,
would be a
bro.
number.
It's just that it's okay. The number you guys are looking for. What's your edge in the long term profitability? It could be
Yes.
I don't know your risk management based off of your profitability. Like
That's not a number though. Give me a number.
if you're 75% profitable, if you're
That
60%
doesn't tell me what your
profitable,
edge is. Again,
I get, bro. I didn't study
no,
finance.
but recon. You put $1 into your strategy. You do your strategy
Brother,
a billion
brother.
times. How much do you make?
I'm 75% profitable.
That doesn't tell me what your edge is.
But if you're 70, like what do you mean by 75% profitable?
I
75% of your trades are green.
Yes, 75%.
But then what are the-
Around
But what
about
if
60 to 75% of my trades are green with
Okay,
risk to reward ratio of more than 2 to 3 RR.
Right.
Because
So
I only target higher RR risk to reward.
yeah, the problem there is like
What's the
you
size
could
of the
just-
trades that you're winning or losing? Is it all equal?
No. Well, oh, you're talking about, yes, that is all equal. No higher,
amounts.
none less.
Okay.
If I take 2 losses, I de-risk. I de-risk and drop risk. You guys got to understand. If you're profitable in the prop firm,
That kind of fucks up what you just were saying. I was trying to actually
Yeah.
work through the. If you're
I was
if
gonna
you're
say, if you're gonna bet the
decreasing
same amount on
risk
each,
as your
then-
drawdown goes, like really complicates the math more. I was trying to run it through in my head.
I
point
get
being
you
is
guys, but
like-
you guys are trying to make the math more in depth of understanding how to get that extra 10% from that payout. Guys, we're talking about somebody who's actually profitable and has Their edge is with prop firms is basically being
Yeah.
profitable, like that 65, 75%. But you have to
here's
target.
here's the problem, recon. Like for instance, okay, say you said 75% of the time you're winning with like a higher risk to reward, and 25% you're not.
Yes.
Say you only took like 4 trades a year, and you won I guess 3 of those and lost one of them.
Mhm.
You seem pretty profitable, but at the same time, it's like, well, what's going to happen the next year? So it doesn't really tell us anything about the historical like nature of your strategy / what we should expect in the future.
Oh, well, my strategy has been, I mean, if you guys want to look into Russell Pate, he's a quantitative analyst that's been doing this since 1995. Russell Pate, he's built softwares for
Do you even know
major
what a
hedge
fractal
funds.
is? I mean, I heard you say that. Do you know what a fractal
No,
is?
it's not. It's the software is called Fractal and it's used by a remote
Right.
display.
Do you know
not
what a
the act-
fractal is?
Yes, a fractal indicator that you use on TradingView.
What is like the mathematical definition of a fractal?
Oh, the mathematical definition of a fractal. No, you can't. I can't sit here and tell you what that is. I definitely do not know.
Hold on,
Okay,
you say
well, let's just
Russell
like
Pate?
repeat it out. Output like microcosmically and macrocosmically, but
What's his?
the point being is like that doesn't really like, especially a quant model back in 1995 is not going to have any edge.
Wait,
now.
hold up.
And other
Hold
than
up,
like
is-
a few
Is Russell
selected
Quant with
ones.
Alpha Daily Consulting? Like, where's Russell? What's his firm, or who is this guy? The Russell guy you're talking about?
Russell Pate. Russell Pate.
Yeah, Pate, right?
Yeah, Russell Pate. Yeah, Russell Pate. Yeah.
Okay, but like, has he worked at a firm before? Like, what's his background? Does he have a
Yeah,
PhD
he's worked
or-
for Forums. He's now retired and only does his own
for
thing.
where?
I couldn't tell you. I don't know the guy personally. No.
But like, does he have like an actual quant background or?
Yes, he does. Yeah. He built the software, coded the software, everything. I mean, I can show
If
you.
the software is public, if the software is public, I can with 100% guarantee.
It was
does
not public. It was not public. It just
How did you
became.
get your hands on it?
He gave it out 2 years ago.
Okay, well that means it has no
Wait,
edge.
Yeah, it means it doesn't do anything then. Yeah.
Then how am I profitable? How am I profitable? I've started
You got
using his
lucky?
I guess
software about
luck.
2
I
years
mean-
ago.
Variance.
Because,
all
like,
that is.
let's just say with ICT, I guess if you guys don't, a lot of people are against it. With ICT, I've been profitable prior to
Recon.
fractals.
I'll tell you how.
Yeah.
Wait, Recon, you can flip a coin, right? You can get head 10 times in a row, right?
I mean, no, you can't. But you
Yes,
really,
you
if
can.
you really,
You
you
can't
could,
get.
yes.
Okay, thank you. So if you're betting $1, you can win $10 flipping a coin, right?
Yeah.
Does that mean that you have a strategy that makes you win flipping a coin?
No, that's.
Thank you.
no.
So it's the same thing, right? That's what we're
And it's like-
getting at.
If you are profitable, like, aren't you curious, like, how to actually being able to
Determine it,
articulate
or-
it and
yeah,
like
or-
logically come to the consensus that you're going to be profitable in the future? Like, how to quantify that profitability? I would
Right.
be curious if I were you, right?
I mean, yeah, obviously, but we're talking about involving AI to code our strategy to see if
You
it's
don't have to use
profitable.
AI.
Okay, but honestly, then how are you going to code? How are you going to really?
You don't have
test
to.
it?
what
You could just
you
use
can
your
code for
your
yourself.
historical returns.
Historical returns, yes, but how are you going to base that off your future? You said it
Because
yourself. We don't know what the market's going to do
You
ahead.
can take your historical returns versus the market
Yeah.
returns, compare, and so then you establish your portfolio's beta, and then from there you can back into an alpha.
Yeah. You can build out like a CAPM model. They'll tell you. Does that make sense? Or do you know what CAPM
Yes.
is?
No, I don't. But I understood what you guys were talking about in regards
Yeah.
to building the model to give you the back end. So, I mean, I'm a
Alright.
business owner. I've been doing this.
Gotcha.
I own a few businesses.
Well, okay, I don't know what that has to do with trading, but congratulations.
Hey, Tiki, can I add something? I have to go, just real quick.
Yeah, no worries. Go ahead.
Something else I want to say is that
Yeah.
making money with prop firms is very different to also trading with a live account too. You got to
It
remember
would be
that.
this exact same thing. Actually, no.
No, it's
prop firms
very
would be way
different.
worse.
It's very different.
Hold
Yeah,
up,
man.
It's
prop
not,
firm-
it's not a matter of
It's
way
very
worse or
different,
not.
man.
It's
Guys,
different.
Hold up. Hold up. Edie's, is a prop firm not just simulating the actual market?
No, I'm telling you, it's very different. Like you can make money income versus outcome with a prop firm.
No, but that's not what
Like,
I'm.
and it can be completely different to trading. Is what I'm trying to say.
Edie's, are you trading a simulated market of the actual market, right?
What
Yes.
does that have to do with anything? I need
So it
to.
literally
Well,
is the
I just
same.
want.
Talking about
I just
business
felt like
wise.
you're
Okay,
just.
don't
I don't
hold
know.
up, but
I don't
but
seem to
guys,
understand what being a
Yeah,
simulated
man.
market has to do with anything in regards to being
because
profitable. Well, go ahead.
because it's the same. Hold up, because it's the same thing.
All right, you boys enjoy. I gotta go. Bye. Thank you.
All right,
Alrighty.
take care. But you do realize it's simulated.
I think
If you have
Recon
a
was kind of on your side. I think, right?
maybe I mean I'll let you down, EDs. I got you. Don't worry. But you guys realize that the simulated thing just tracks the actual market. It does what the market does. It'll be the exact same thing doing with the live account. Versus it'll move the same way. It's not going to be different. That's like a prop account. Oh, this stock price is $10 on the prop firm, but it's 12 on the Nasdaq or live account. It's going to be the same thing. So like there isn't.
And you're offered the same lot size.
Yeah,
So if you
exactly.
have a $2,000 drawdown with a prop firm
Right.
and you have $2,000 in equity in a live account, you can
Yeah,
afford the
like
exact same contracts.
I feel like 99% of these conversations is, hey, do you know how math works? And then they're like, no, but I also don't think you know. Like, they're like literally what it is. Do you know Finance 101 and do you know how math works? That's I feel
It
like that's
actually
just what
helps
it
though
is.
because like I feel like I'm like when
Yeah.
you like teach, it like helps your understanding. To be honest, I feel like
Oh yeah,
But you guys
sure.
also got to understand how many day traders actually took finance. How many day traders in this trading realm today? Okay, how
Not a
many of
lot.
these people?
welcome
Yeah,
to the prompt, bro.
Yeah,
Thank
like
you
this
low,
is
for
low
why.
to
today.
none.
Thank
Yeah,
you
this
for
is the
joining.
Very
entire live.
low
Yeah,
to none.
yeah,
And
this is the
people
live.
like and let's just not let's throw them out there. People like Turbo, people like ZZ,
I don't know who
people
those
like
are, but
Shinobi. Like these
nope,
are all
I
people.
don't know who it is.
All people on TikTok, brother. These are all TikTok
Okay.
live traders. If every day trader knows who's on TikTok knows about them. I don't know how you can't, but
They're just okay. But then
yeah,
like,
they're just people
yeah,
who post a lot of trading content.
yeah,
And
that's
these
fair.
they're just these guys.
Yeah.
They use. I've never even heard of this shit, but they
Yeah.
use like inside outside bar. I don't fucking know.
They just
Candle
make up
closers.
terms. I'm sorry, but they make
Bro,
up
yeah,
terms. Yeah, you
that's how I
realize
felt
that.
about that one too. I felt like that was created on their own, but yeah, they're like inside bar, outside bar bullshit. I don't know, but anyways, they're still profitable with it, guys. Everybody's
But
profitable with their own edge, right? You guys want to
no,
know?
but like no, but Recon, they don't have an actual provable edge. You can say you have an edge, but unless you can actually prove it, there is zero evidence that you have an edge. Like you're just spinning a slot machine and you're saying, "Look, I made money spinning a slot machine. The way I'm spinning it, it works." Like that's the thing. So
Okay,
I'm
okay.
asking you,
Let's
like,
go
can
based
you?
off.
Yeah,
Let's go based off how much a prop firm. Let's start there. How much a prop firm account costs? Let's say we put
$100 or
$100.
$200.
Okay.
Plus, how much are your
Now,
fees?
zero. If you're paying $100 like on Tradeify or Top Step or something,
Uh-huh.
there's no fees after that until you get a payout, which is
No, but you have to pass an eval, right?
so obviously
Okay.
past the eval.
So what's
yeah.
your expected value of your eval to calculate that in the price? How much does the eval cost?
The eval and the funded cost is the price should be in between funded and eval, roughly what 50% because you get eval phase and then funded phase. So you split the price in between
No,
two.
no, but
Obviously, there's percentages you get back on the back end that you
no,
pay
but that's not,
yourself,
hold
but that
that's not
doesn't
what I
count
asked
because
you.
that's profit.
Hold up, Recon, that's not what I asked you. I asked you how much does it cost to do the eval?
$100.
Okay, and what do you have to do to pass the eval? You have to make what, double or 1.5 times?
Yes, 1.5 times. Yep.
Okay,
Or
so then your expected
more.
value.
Sorry, that's
Okay.
we gotta fucking make 30x if you're done. If you're starting with $100 because you got to what?
No, but like, hold up. How much win lose? How much win lose to pass your eval?
Versus
Like
the
you,
drawdown, like
yeah. What's
what
the
target
where's
do
the
you have to hit?
drawdown? Yeah.
How much am I
3,000,
like?
you said you
I'm
have to
sorry.
hit
Could you repeat because you cut out there? But I heard what's my win
Okay.
lose?
No. So with the eval, it has a drawdown, right?
Yeah.
And there's an amount you have to make to pass it.
Yes, 3,000.
What's the difference? So 3,000 to pass, how much to lose?
3,000 to pass and 2,000 to lose.
Okay, so that would be a 50% negative expected value right there. You're 50%
Yeah.
more likely to lose. So, okay, and the price is 100, so multiply it by 100, that's plus $50. So 150 is your account value.
Your
Does that make
expected value
sense?
is much less. It's like what you're really saying is like you need to make turning $2,000 into $5,000 would, I think that it's essentially, yeah.
But don't you start from zero?
No, it's 3,000. It's you,
No,
you
but
start.
yeah, but-
well, yeah,
but
you start
Tiki,
at
the way to-
zero.
Tiki,
But
the
they
way to
give
look
you-
at it, the way to look at it is like you have $2,000 to work with.
Yes.
see.
And you have to make you have to get up to turn that into
Oh, I got
5,000.
you,
And
I
that's
got
the
you.
point I'm trying
So
to get
that's
across.
wait, but
Hold on
that's
now.
what is that
Now,
a
can we go back to what I
75%?
was trying to say
Is that a
earlier, though?
75% return?
No, wait, hold up. You said 2,000 to 5,000, so
Yeah,
plus
so
3,000.
that's like a
No, 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 no,
75%.
no. See, this is where you
That's
guys are wrong
100,
and
but that's
incorrect.
150%.
Wait,
No, no, no.
sorry,
You
not.
guys are wrong. You guys are
Is
wrong.
that
I'm gonna
no?
stop
Hold
this
up,
right
don't
now. You
hold
guys are
up.
wrong. You
Recon,
guys are
stop
wrong.
yelling.
Holy
Easy.
shit, that is more than
Dude.
double. I'm
Hold
stupid.
up. How is the hold up?
Wait, so
How's the
Recon,
math off?
so here's the problem. Your probability of that is
Wait,
probably like
hold up.
You guys' numbers are
less
incorrect.
than
Wait,
1%.
hold up. Recon. Wait, guys, stop for 1 second. Recon. How much more? Okay, 3 times x is equal to 5. What is x?
3 times 5 is
Or
equal
2
to
times.
X.
Wait, 2 times 5 is equal to x. What is x?
10.
3 x times. No. What times 2 is equal to 5?
What times 2 is equal to 5?
Yes.
Fuck, I don't. 2.5 times. I don't know. 2
Yeah,
point
it's
something times
2.5.
2
Yeah,
point
it's
something.
2.5.
Yeah.
Yes. Right, it's 2.5. What
Yeah.
that means is you have to get a 250% return to pass your eval. But if you lose 2,000, you're out. So you lose 100%, which is a 2,000 count value, you're out, but you have to make 250%. So that means you have a negative expected value of 1.5.
But that can't be
Is
right,
that
right? Isn't it? Wait,
It's
actually,
$2,000 drawdown for
I
$3,000
kind of struggle with
profit.
basic math.
It's
Is that
it's
really
4,000.
250%? Would that not
It's
be
no,
125%?
it's 150% because you have to say like
150%.
yeah, 150 because yeah.
Okay,
Yeah.
wait, but here's the point though. Your probability of making 150% return in 1 month is definitely less than 1%. So I mean, we'll just be very conservative here. I'll even give you 5%, right? So your expected value of that $100, right, is, I guess that just wait, how would you do that? You would do, this is why I need
No,
This-
I'm
Songcup.
just I'm just
Songcup.
That's
comparing
what
it
I'm
to
trying to
like
get you guys to
Your
understand.
expected
That's what I was trying
value
to talk
is
about.
horrific.
yeah, I'm assuming that you have an equal likelihood of it going up or down. Granted, it's slightly skewed to the upside, but it's negligible. It's like a point whatever.
No,
Call
no,
it
no.
50-50 chance or
That's the probability I'm assigning. I'm saying that
yeah.
you have
Also, this
a.
is
We'll just say you
interesting.
have
Got a
you
Tetris
have
flavor.
to be
G
really
Fuel.
conservative here. We'll say you have
Yeah.
like a 99% chance of failing the account in a one, and that's conservative. If you're expecting 150% return in 1 month, you got virtually no chance of doing that. So
Oh,
like your
brother,
expected
the
value,
return I get on these counts, I
your
fucking make
expected value of that
150% off 100 in one
$100,
day.
your expected value of that $100 is like next to nothing at that point.
Isn't it like negative 99 then in that
No, it
case?
wouldn't be net. It would be like $1, right?
Oh
Yeah,
yeah,
it would be
it's yeah,
$1.
but that, you lose $99. That's what I'm saying. You put in 100, you get back expected
Yeah,
value of
yeah,
$1.
$1.
Yeah,
Yeah,
so
I
it'd be
think that's how
minus
you would
99.
calculate it, right? This is
Yeah,
why I need
or
Sonk up here. Sonk is the most technical.
is he?
Yeah.
Is Sonk in here? Where's Sonk? I don't see Sonk unfortunately, but anyway. But like the point is, you get $2,000. You have to put that up to 5,000. You can't lose the 2,000. So that means you have
No.
100%
Well, let's
chance.
go off of real numbers. Let's go off of real numbers, guys. Let's go off of
Okay.
true numbers, not just throwing freaking fake numbers out here.
No, this is true numbers.
No,
Like,
the-
you're talking about
well-
making 125% return in 1 month.
I know, but what we're like the targets we're talking about are not correct. So it's $2,000 drawdowns for $3,000 target. It's
Well,
4,500.
125% return.
Yeah, and it's $4,500 drawdown for a
150%.
$9,000 target. So this, I guess you would say the return is a little bit different than that, but it's definitely not $2,000 in drawdown to catch a $5,000. That'll be crazy. So the target is $3,000 with $2,000 in risk, guys. With the 75% profitability, if you're winning 7, even 6 out of 10 trades with a higher RR, guys, your edge is your strategy. If you have a profitable
But that
strategy,
doesn't tell me what your okay. But saying your edge is your strategy doesn't tell me what your actual value of that is. It's like saying, your return is your return, and ask you what's your return, and you say, oh, I don't know, it's just your return. Does that make sense?
to tell somebody you don't know what your return is crazy, because I can tell you my
That's
return
what
and
you're
it's over
saying.
$1 million.
But when you say, when I ask you what your
A
edge
year,
is,
by
like,
the way.
I didn't ask that, but like I'm asking you what your edge is. Like, oh, I don't know. It's the same thing as you saying I don't know what my return is, but I have a return. Does that make sense?
Yeah, 100%.
Yeah.
That makes
And look, it's
fucking-
fine. I'm not saying this is impossible, but like this is just like flipping a coin, and you have to get it right 4 times in a row. But if you get
It's
one
way
wrong, you
worse than
lose.
flipping
Yeah.
a coin. It's like not
No,
even
what I'm saying is you have to
comparable.
The
You
thing
have to win like
I
4
don't
times in
get
a row
what
to
I'm
win.
trying to get you guys to understand that prop firms and live accounts, yes, you have a higher chance of making I guess you would say making more money or taking less losses, right? Being more profitable in a live account, but it's not, I wouldn't say for the average trader, and I'm sorry, not you guys who've been studying finance, but for the average Joe Schmo trader, the difference probably wouldn't be too crazy. It wouldn't be too insane, right? And we're talking
It
about
would if you're trying to, in
Yeah.
any capacity, whether you're trying to do it in the short term and the long term, your odds of making money are higher if you're not using a prop firm.
yes, agreed.
Significantly. Yeah.
That's like proven scientific fact or mathematical
Yes.
fact. Yes,
Yes.
that is 100% true, right? Now,
Mhm.
does that void people from stating like their current strategy on prop firms and stuff like that does not work? No, it doesn't. Because then I wouldn't be here trying to debate with you guys, telling you that, guys, I've made a lot of money through prop firms.
Dude,
And I can
hold
tell
up.
you one thing.
Wait,
If you
Recon.
if you risk
Recon.
correctly, go ahead.
Recon, can you make money spinning a slot machine?
Guys, this is
Hold up, it's a yes
options
or
is
no.
a slot
Wait,
machine. Okay, whether you're a
Recon.
quant, whether you're in
Oh my, he's
finance,
not listening. He's not. I don't think you're quant. Can you
I
make
am
money spinning?
listening. Yes, I am listening. Guys, when
Okay,
you
hold. Not
participate in
answering
the
my.
market,
Okay, he's not. No, you're not listening because you're not answering my question. Can you make money?
it's a
spinning
slot machine. It's a slot machine.
That's not
But
what I
guess
asked
what?
you. The whole. Oh my. Oh,
Okay,
Lord. Can you
go
make
ahead.
money spinning? Can you make money spinning a slot machine?
Yes, you can.
Does that mean you have a strategy?
No, it does not.
Thank you. Right. That's the entire point. None of
So,
what you're describing is a strategy.
so
You're
just
just
because
saying
you're a
like,
quant, just because you're a quant in finance, does that mean you have a strategy?
yes, you would literally have to have a strategy to be a quant. What are we talking about here? Yes.
Okay, so just because you went to college and got a PhD on your strategy, or I don't know how you guys get it for quant. I know you have to like take certain tests or something like that, right? You have to like pass something or whatever.
So we have
Anyways,
technical interview, but yeah.
yeah, right. You have like there's like an interview or something
Yeah.
where they test your analysis, like I don't know, they code it with a bot or something and test it. Anyways, so basically, you're still gambling just because you're a
No,
quant.
because
Yes,
no, you're not.
when you
Because,
are
no, hold up.
participating in the market, no matter what,
Is it
you are
casino? Hold up.
gambling.
No, that's not how that works,
Every
Recon. Why are you?
person,
You're denying
it does
math,
work like that.
Recon.
It,
Recon, you're denying
bro,
math.
I'm not denying
Yes,
math.
you are.
I'm
You're
telling no,
literally
you're
okay because you
denying.
keep cutting me off. You're not even letting me. You're not even letting me talk right now.
Okay, I'm
'cause
sorry. Go ahead. I'm sorry. You're right.
Okay,
I'm sorry.
casinos, right? Are casinos gambling?
Oh fuck yeah, I gamble a lot.
No, or is the casino itself, the house, is the house gambling?
Oh no, the house is not gambling
Why is the house not gambling?
because of course the house always has the edge.
Thank
W
you.
host. W
Quant
host.
quant traders have the edge. That's why it's not gambling. You don't have the edge. That's why it's
How do
gambling.
you
That's what I'm
know?
saying. Hmm?
How do you know I don't have the edge with fractals?
Through
How do you know?
statistics,
Have
just
you
like a
even
casino does.
looked into Russell Page software and have you just tried? You probably did one Google search of the 2 minutes. Probably actually do some deep research into this guy. Okay, probably do some deep research into this guy Russell
The
and
point, it's
actually.
Can
public,
Sonk,
but it's
wait, host, can
public.
Sonk come up?
I don't know if Sonk is here. Sonk, please request up if you're here because this is the math guy. I'm assuming Sonk will hopefully know because I would love to hear Sonk. Oh, there's Sonk. Hey, yo, Sonk.
Hey, I
there's
support quants, bro. I love quant software. This Russell's awesome, but we can't deny
quants
that.
have, but hold up, but
Yeah.
quants have proprietary software. If it's public, it doesn't really work anymore. That's kind of the thing about quant. It has to be proprietary for it to work.
I think the important thing that you aren't realizing is the standard deviation of the movement of the market. Like NASDAQ or NQ or everyone tell it, it can move 2% a day on average,
Mhm.
right?
Yes.
So, and depending on how much leverage you have, right? If you have like a 1 sigma or 2 sigma move, so it's like 2 or 3 standard deviation movement, which would happen 32% of the time, essentially what it's saying, right?
Can you please speak up a little bit, Sonk? It's a little hard to hear you. Sorry,
Sorry.
just so everyone could hear you.
But essentially, like if you move like a 3 sigma move, and that happens,
I can't turn Sonk up.
one
Sorry, Sonk, you're just like a little quiet. That's all. Yeah. I don't know if you can speak up.
What about now?
Oh, a lot better. Yeah. 10
I don't
times
know. My
better.
headphones must be broken.
Oh, we hear you really good.
Yeah.
But essentially, it's essentially looking at the wiggle I'm trying to dumb it down, but the wiggle of how something moves versus the return you're getting on that, right? So if it moves on average 2%, and then the standard deviation is about like 1.4%, trying to really just think about the easiest way to explain this. But
Yeah.
essentially, so like 32% of the time, if you will have like a 1 sigma move that you need to make sure the return is there for that.
Yeah, I think he's just trying to like dumb down like the easiest way to describe what variance is.
Okay.
Yeah, like what I'm pretty much trying to say is like you're essentially risking something moving, call it like $500 to possibly make 300. So and again, the market on average goes up, right? But all you need is that to happen a couple times, and then you're wiped out of your entire account.
Right.
Which is what the whole Sharpe ratio and people like you would want to take a 3% return with way less variance or way less lower volatility, because that means it's consistent. That means variance isn't driving your returns. It's actually strategy.
Mm-hmm.
Yeah. You also would have to have a positive edge, meaning a positive expected value for this to work, other than, you just catch variance in your favor, which wouldn't mean you have a strategy, just means you're getting lucky with your variance. Basically, you have an expected value, like whatever the long-term expected value is, and then there's variance to that. Because the variance can be negative or positive, as long as you're catching positive variance, it looks like your strategy works without you having to actually show or know that you have an edge or prove you have an edge. You just think you do because you're catching positive variance. But if people were to try your strategy, more than likely you don't actually have an edge, because to have an edge would require so much more than just what you're describing. You'd have to like have a certain level of information and math skills that I don't believe you have, which is fine. 99% of
And
people
like
don't have.
it's super hard. Like I try it for
Yeah.
fun, and like I do a direct indexing strategy, and I try to have a slightly better Sharpe ratio. And I actually just looked it up while I was on here, and I'm still slightly below the market after tax adjusted. It's better, but like it's really hard to beat the S&P 500 unless you spend a lot of time doing it.
No, I
Yeah,
definitely agree.
Yeah, and even then, you're not guaranteed. Like, there are no guarantees. You have to have like a mathematically proven strategy, and even then, that can break down and stop working. There's been hedge funds that have been
That's what I was trying to
completely
get to
destroyed
earlier. Sorry.
overnight. Yeah.
And I'm
But
sorry,
just
you
also
just
wait, just
contradicted
real quick
yourself.
before I
So,
forget this.
did
Wait,
you
just real
just?
quick before I
Go
forget
ahead.
this. Like I think you can make this far more elementary than we're even describing it as. Like you were trying to make an effective 150% return with, like, we'll just say unlimited capital resource, or as much resource as you would need,
Yeah.
like in a matter of a month. And to me, and I think
Thank you for the rose.
anyone, that's like an absurdity. So
Yeah. So assuming it has a likelihood to move in either direction, let's just assume it has a likelihood to move in either direction. The fact that it has to move so much more in one direction as opposed to the other one means that you're you're like a significant disadvantage.
also, I kind of misspoke there. Not with
Yeah.
the capital. Maybe I'm not thinking about this completely correctly. But to me, it's effectively trying to turn $2,000 your drawdown into whatever your target is. But given you have more leverage, maybe that differs the math slightly. But to me, I think if you still were to do it, it seems pretty improbable.
Yeah.
So
Yeah, but
to
even
the
on
spec-
that, the swing, like the standard deviation is higher than your expected return, like on a dollar basis.
Right.
So
'Cause
if your volatility is higher than essentially your expected return on a dollar basis, then you're playing against the house.
Yeah. Like, I don't think day traders, a lot of them realize that what you're buying is mathematically against you. Like, if you keep buying what you keep buying, like, you will lose money long term. It's just a guarantee.
And that's the thing, right? You can get lucky and have this, like
Right.
you can make 100% return, right? But you're essentially risking 300%.
Yeah, but would you
in
call luck
variance.
being profitable with prop firms for 3 years? I wouldn't call that luck, man.
I
Well,
would.
yeah, because
And-
the difference between like roulette and the market is like you have certain regimes, especially like in like a long term sense, and like even if you've been in the market for the past few months, actually the past couple of months, we're in definitely even a different long term regime than we've been in for a while. So it's slightly different in that sense to like roulette. Because your regimes, there's no like differentiation in regimes. but
Also,
yeah,
when you
so
say regimes, you're talking about like kind of how the market moves.
yeah, essentially like the odds of like a roulette being black like a million times in a row versus like in the long run, the market is going to behave like a roulette table in that sense, but there's can be variance in like the streaks
So
of
what was I
black
gonna
and
say?
black and red, if that makes
Also, you
sense.
said that you were profitable for 3 years, right?
Yeah, I've been
Yeah,
profitable for the last 3 years, almost
there was
4.
a hedge fund too that was profitable for 3 years, and in the fourth year it blew up and lost $4 billion.
Long-term capital management is probably one of the famous
Yeah,
ones, right?
that
Like
was one
there's
that's what I'm referencing. Yeah, they lost $4 billion. They had to get like a $4 billion bailout, and that was by math PhDs. And one day the math just broke down and stopped working, and it blew up. So, like, that's
That's
the thing
crazy.
too. Like, you can have a strategy that works too on top of that, but it could stop working literally any day for any reason.
and it's because they didn't quantify their risk and the volatility of what they're doing. They didn't price in a black swan event, and it was like a four sigma move
I
on
see.
the market. So
Yeah,
it's
because
again
it's
like
probably
if you don't look at how the volatility of your
yeah,
returns, then if you have low volatility and consistent returns, then that strategy is something that's provable and you pretty much control for variance. So it's you have
yeah,
edge essentially. If you
that makes
don't
sense.
know what the standard
And then
deviations of
Ken Dog,
flows
if
and
you're interested in other hedge funds that blew up, there was Julian Robertson's fund that lost money trying to short the dot com bubble before the dot com bubble went down. Julian Robertson, I believe it was called like Tiger Global Management or something like that. Just look up Julian Robertson. His hedge fund also blew up. Um, yeah, there's a lot of hedge funds that blew up. No, not a micro. That was one of the biggest ones. Julian Robertson. He's one of the most famous ever. Melvin Capital also broke down too. Yeah, that also blew up. There's a lot of hedge funds that blow up. It's very common. Like even the guys who actually know what they're doing don't know what they're doing a lot of the time. Um, Also, Jack, you've been waiting here. I'm so sorry to keep you waiting, Jack. How old are you, Jack?
Oh, good. I'm 18. I just have some like
Yeah.
questions. You guys seem like really smart. I don't know like all the technicals you're talking about, but I mean, I trade right now.
Hmm.
I haven't been profitable too long, maybe like 3 months.
Yeah.
I'm just looking like for guidance. I mean, because you're
Hmm.
saying I use ICT as well, and you're saying whatever ICT is
Yeah.
obviously not the best strategy for trading, but
Or Jack,
whatever
I'll
I just
just
started out.
I want to.
Sorry.
Sorry to cut you. I just want to put this as simple as possible. There's really going to
Yeah,
be two types of strategies. There's going to be the strategies that make money and the strategies that don't make money. If
yeah,
it's a strategy that makes money, you're never going to hear about it because that's going to be locked away in some firm in Chicago or Florida.
yeah.
Like they're never going to tell you that because if someone can make money off their strategy, they would just try to max it out, make as much money as possible, and once it stops working, they retire or they find a new strategy.
Mhm.
That's all. So the strategies that you're learning, where you're seeing all that is just strategies that people are getting lucky with that are not proven to work. So if it works, everyone does it, it stops working. So for example, look at the stock market like buying a bunch of things. If I told you, hey, go buy, C thing at this price, you'll make money every time you do it. Or just go buy this stock, you'll make money every time you do it. Eventually that stock's going to run out because everyone's going to buy it because you make money. I'm
Yeah.
just trying to like dumb it down as much as possible. So because of that, you can get these strategies that may have even worked in the past, but because it's already been like played out, it stops working, and you're never going to get access to those strategies that work. So, regardless of what you're looking at and what all that stuff is just going to be already like played out. You're going to maybe get lucky with variance because if you think about it, it goes up or down. You may get lucky, it goes up, it goes in your direction, and you make money. That's possible. But that doesn't mean what you're doing long term is profitable. All it means is you're spinning a slot machine and the slot machine's paying you. That doesn't mean it's going to be forever. You keep spinning that slot machine, you will eventually lose everything. Does that make sense? Because a lot of these are negative return assets because a lot of time they're priced against you as well.
So do you think Michael Hudson has a secret strategy hidden in his book that he's not posting on YouTube that he doesn't give out to anybody?
Who?
Michael, the owner, Michael Hudson. He's the creator of ICT, the bald guy.
Hold up. I don't. His strategy wouldn't work anymore. If it worked, it would stop working. So it doesn't really matter.
So what do you like
But
recommend
also,
then to look
I
into?
think
What I'm
there's
trying to get at is because he's
wait,
still
but real
successful
quick,
with ICT.
I
So
think this is
how,
important to like. I'm not like I hear people say this is ICT. With you talk about like
I don't
Like
praise him,
you
by
said,
the
like
way.
order
I'm just
order
using him as an example for right
like
now.
order blocks and like draw. You said like draws on liquidity,
I didn't say none
stuff
of
like.
that. I'm
Well,
just
what?
I'm using him an example. I'm using
Yeah,
him
but I'm
as an
saying, isn't that
example.
ICT? That's ICT.
Yeah, yeah, yes, sir. Yes, it is.
Yeah.
Yeah.
And what I'm saying is like those terms don't actually necessarily define what's happening whatsoever. It's like fugazi. It's nonsense.
It just made up terms, like literally just made up stuff.
Like you're not actually specifying why this is a draw on like liquidity mathematically. You're just kind of saying because there's a wick here or what because it's
what's a
moving
good
in, because price is changing at this certain point that like that somehow is like drawing on liquidity or like excess liquidity.
All right. Well, then I got a question. What would you recommend I get into
if you actually wanted to really do trading and
yeah,
really get into it,
Like
you have to
applied
go.
mathematics.
Yeah, like go
how's that?
college, learn really in-depth math,
Uh,
apply yourself to like trading competitions, stock investing competitions at your school, be a student portfolio manager. I was a student portfolio manager. I don't know what universities are available to you, but there's universities, well, they will let the students invest millions of dollars from their school's endowment in teams and groups under like the guidance, of course, of like a professor or something. But you can get like literal experience actually investing, like what it feels like to be somewhere where they manage millions of dollars. Of course, it'll be controlled. You can't do everything that you may want to on your own, but that will give you like the background for it. And then you would take that and you would go and you would apply yourself to like a finance firm or investment banking. And then from there, you would make, sorry, come back. Yeah. And then from there, maybe you would get a master's or you would go work on a trading floor. And then you can work into like a market maker, maybe if you're lucky, some sort of a quant firm, if you really,
yeah.
but that's it. There's no easy way to it. I could, I don't want to sit here and lie to you. Like, there's no easy way to do it. Yeah, you can see guys who didn't go to college and they're like, oh, I'm successful trading and all this stuff. You can see that, but none of those
Don't get
guys.
larped.
Yeah, don't get larped. Yeah, exactly. Like none of those guys, I can almost guarantee understand what they're doing. They're just getting lucky. And you can always find that rare example of that one person who knew what they were doing and they had that strategy. But again, that's like one in a million. Like more than
But
likely, you're just always better off just going to college.
but also the best starting point and the best starting point is just like understand like taking a basic not just like corporate finance course but like portfolio theory course
Yeah.
which you get through a finance education because like the terms that you've heard host use and me use and Sonk use they're not this is like what you learn in like your intro portfolio theory
Yeah.
class. They're not
You-
like complicated
Yeah.
but
This would
like
be
it's
like your
important
first
to
assignment.
but the reason that's important is it's not going to like help you necessarily like develop a strategy but like you can at least like be able to articulate and understand whether a strategy works or not. Like if you don't understand like alpha, which is like the end all be all of a strategy, because that's like adjusting for market drift. If you're not understanding like what the concept of alpha is, then you can never really understand whether you have an edge on the market or not.
Right. And I'll just kind of quickly break down what alpha is for you so kind of get an idea, Jack. So
I know a little bit about the Greeks. I'm not like 100% on them, but
hold up, Recon. I'm sorry, I'm gonna mute you because there's a lot of background noise. Sorry, but Jack, I was gonna say this. So alpha, like probably the most important concept, just something to get. So all alpha is your return over your benchmark. So let's say you have two choices. You have the choice to invest in, say, the S&P 500, the broad stock market, and you have the choice to do something else. If you don't have alpha, meaning you're not beating the benchmark that you have, it's pointless to do anything
With
else. Like
less
you're just
risk.
wasting your
With
exactly.
less risk. The
With
important
less
thing is
risk
you're
too.
always taking the concept of like risk is like paramount.
I didn't want to even
Yeah.
say that, but I'm assuming that I didn't want to go into the risk class because it's a bit more complicated. But basically, you have an option. You can do stock market that's 9 to 11% a year, roughly, or you can do something on your own. Let's say you do something on your own and you don't get 9 to 11% a year. You're wasting your time. It would be better just to invest your money, you work a job, and you would make much more money like that long term. And we're not even talking risk adjusted, none of that stuff, because that also plays into it. But apart from that, I just want to make it as simple as you possible. The best way to look at it, you can get 9 to 11% a year that compounds and do amazing and work and make a lot of money. Like imagine you get a job, let's just say making 80 or 90K or whatever, you'll make. You can do that and invest, maybe 20, 30K in a year, depending on your circumstances, and get 9 to 11% a year. Never have to worry about the stock market, never have to worry about these terms or anything forget all this stuff. Never really like long term, you're not risking your money. Stock market long term, it's positively correlated to time. That's the one thing that's almost a guarantee. In the future, like say 10 to 20, 30 years in the future, the stock market will always be higher than what it was before. That's how it's been ever since its inception, in America at least. Other countries, not the same, but in America, that is the case. That's what all
Then
the retirement accounts are based on.
and
So just
also
take advantage of that. Yeah.
also real quick, Jack, like it sounds counterintuitive, but like for instance, you could make like say double or triple or quadruple what the
Mhm.
stock market makes, but if the risk you're taking on, meaning the variance in all your
Yeah.
returns, if they're like orders of magnitude greater than the stock
Mhm.
market, it would actually still be better to invest in the stock market. Long like in terms of like
Yeah.
actually wanting to grow wealth.
Right. And
Which
it's
sounds counterintuitive, but that's why it's really important to take just like a intro
yeah.
portfolio theory class, and sort of understand those like sort of counterintuitive, um, like abstracts or concepts.
Yeah. Also, Jack, like you don't even have to worry about like all the stress that comes along with it. It's basically a problem that is almost impossible to solve. There have been people who dedicated their entire lives to trying to beat the stock market and have failed consistently. Does that kind of
Yeah, no, yeah, that makes sense. And
yeah.
then, like, really, I just have like one more
Mhm.
question.
Yeah,
Like,
of course.
I've got about like 10 to 12K in payouts
Hmm.
from prop firms. What do you
Yeah.
recommend I do with the money?
And you said you were 18?
Yeah,
Put
I'm
in a
18.
live account. Put
Yeah,
it
just
in
put
a
in a
live
live
account.
account. Yeah,
Live
absolutely.
account.
Because like
And
fuck
yeah,
it, like you're young, like
mhm,
you might as well still
yeah,
explore trading, but put it in a
Yeah.
fucking
yeah.
live account.
I would say this, Jack. Take the money that you won, stash at least like 10, maybe 15K of it. Set aside some money you're 100% comfortable losing. Also, figure out your tax situation. Don't get screwed on your taxes. I don't know. Yeah, make sure you announce all that post tax. Take whatever you're comfortable losing and do whatever you want with it. Gamble with it. Go trade. Do all this stuff. I'm not gonna say don't do that, but do realize that you got lucky, and it's always good to just kind of step out before you get lose everything.
But also
All
kind
right,
of
well,
fuck that. Like you're young, like you can still work like I would honestly
Yeah.
put those payouts into an actual like Trade Evade account, for instance, or whatever
Oh, you can do that too. Yeah.
and just like
yeah.
explore like I think it's like even to lose money
Oh,
is like incredibly
oh no,
beneficial.
but no, hold up. But Jack, something you have to also realize is the expected value of your dollars right now are significantly higher. Because here's the thing: if you invest right now, right? You said you're at 19, 18?
Yeah.
Right. So every dollar that you invest right now in the general stock market, because of the way it compounds, is worth significantly more in the future. So the reason that I'm saying like keep say of that 18,000 like 15,000 is because that 15,000 20, 30 years in the future is going to be worth like a quarter million.
Yeah, I was
Yeah.
doing the math while you were saying that, Tiki. And if you put that ten
Yeah.
thousand in now in 20 years, get 10% a year. By the time you're
Yeah.
38, that 10,000 will be 600,000 essentially,
Wow.
585.
Yeah.
So,
And that yeah.
but
All right.
again, like
Well,
I agree with Scott as well though. Like put
Yeah.
some off the side, but then also if you want to explore trading
Yeah.
and learn
Do
more,
both
like
basically. Yeah.
do both.
Yeah, do both. Just make sure that you understand like you are putting yourself at a disadvantage, but the purpose you're doing this is so you kind of learn and understand how these things are because you're
yeah, yeah.
interested, you experience success, you don't want to just quit. And I get that. Important part is to recognize that you're not gonna, you know, recognize that what you experienced is just volatility working your direction. Good
Mhm.
chances that you lose long term, you don't actually have a real edge or advantage. If you're genuine about this stuff, you're really interested, go along like going to college, learning the math, take, financial engineering masters. Those are real things that are very complicated. Not like 99% of people probably would not be able to like pass those concepts. If you're really passionate about this stuff, learn that stuff and then come at it from the angle of like, okay, I know what I'm doing and I can prove what I'm doing with math, with numbers, things that do not fail. And maybe from there you can go and work in some firm to some capacity in finance in these things, and you'll do great. Basically, that's best advice I can give you. And those guys make really good money. Like, I looked at some of the financial engineering degrees. They're all master's program, typically 2 years master's program. They pay between like I think like 150 to 180K on average. Especially get into like a high end one, you could be making, 180, $200,000 before you're 30, which is really good money. But of course, that's if you're interested in that stuff.
Yeah. And then, what do you guys think about like leverage funds?
What do you mean by a leverage fund? Like,
Like, I mean, like how you can leverage like QQQ example, like for example.
oh, I know what you're talking about. Yeah, yeah, like a 3x leverage fund.
Yeah.
You gotta actually look into something like the way it resets. You have to look into how those funds mechanically work because the part with those funds is because they're 3x leverage. If it loses X amount, it actually goes to zero. Does that kind of make sense?
Like
Yeah,
it's
yeah.
going to
I'm gonna I'm gonna look
compound.
into that
I
more.
can actually touch on this a little
Yeah,
bit.
yeah,
It's just going to, like, even a two, any sort of leverage is going to compound in one direction, obviously. So like if your benchmark, like the underlying asset, goes up $5 and then back down $5, like you've made nothing, your return is zero. But with a leveraged account, it's going to be actually positive in that sense, but
right.
also to the downside negative. So it would only be used if you had a strong conviction on like a directional move, if
Yeah,
that
Basically,
makes sense.
Yeah, I was.
it's a good way to make a bet on the stock market going up or down without having to like go into financial derivatives, but it's technically still like it's just it's like a weird thing. You have to, I would say, read into it more yourself, but the math around it is a little weird. Is
Yeah,
that
I was about to say people. I disagree with people doing like QQQ because it's kind
yeah.
like I feel like you should be thematically driven, and it's kind of just a way to avoid like to your point doing derivatives and having
Yeah, like
to
you don't want to use an
like
option, but you think the stock market's going to go up a lot, but you don't want to use an option, so you buy like 3x leverage TQQQ, or you think it's
yeah.
going to go
I just
down,
don't
but
understand like doing it on the broader
yeah,
market. I feel like you should be much more thesis driven if you're going to try to do 3x leverage.
yeah. Does that kind
Or
of make
any,
sense?
it's got to be
yeah.
like
Yeah,
strongly. I
Yeah,
would,
um,
I would say like unless you had like kind of a
yeah,
heavily quant
and
strategy, like I wouldn't really use a lever. Like if you got a great enough strategy to dip into a leveraged ETF, you should be familiar enough with derivatives that you can construct the same vehicle
yeah.
yourself and avoid the fees.
yeah, and also there's this YouTuber who is a former hedge fund manager. His name is Patrick Boyle. He makes a lot of content. Now it's more so news, but a lot of his older stuff revolves around actually breaking down like derivatives and kind of that stuff. So it's also worth looking at him because he's a former hedge fund manager. He's just like breaking down what these things are. That's always worth looking at. He's on YouTube, Patrick Boyle. I would recommend him. Yeah,
All right, I appreciate you guys. Thanks for the insight.
appreciate you. Yeah, no worries. Thank you too. Yeah,
You guys have a good
appreciate it,
one.
Jack. Thank you. And I'm gonna have up maybe like one or two more guests, and then I'm gonna call it. But thank you, Jack. Okay, we're gonna go on to the next person. Natalie Olivia? Natal no, or whatever your name is. Also, I realized something with all these funded accounts. If they're making like without the compounding, they're like, how much money are they losing without compounding? Like that has to amplify their losses because you could compound if you're a successful trader, but you can't compound on a prop account. I wonder how much that takes away. That would be like, oh my God, that's so much more than the 10%. Because here's what I was thinking: like, say someone makes 100,000, their loss isn't the $10,000 in fees. It's also like the loss from compounding.
Well, you're still compound, like you can still compound technically, but your factor is less,
Yeah, which is like, yeah, that's probably where most of the,
which
yeah, it still
diminishes like the
destroys you.
risk. Yeah, it's still it
Uh,
Well,
diminishes
it
the
goes to the
risk.
point if you have edge and you believe in it, then you that additional amount over 10 years is an insane amount of money you're leaving on the table.
Yeah, it would probably be like, yeah, because some of these guys like they're saying like, oh, I made $1 million or something. That has to be like hundreds of thousands they've lost and like missing out on the compounding. 'Cause I don't know what they
Yeah, if they
started
actually
with,
made
but
millions of dollars.
yeah, because you imagine like it's a 2K account to make it to 1 million, you would have to get like what a 50,000 X return or no 5,000 X return,
Dude,
500 X.
I've realized my like new thing,
Yeah,
like instead of being against the trading courses, like honestly, the prop firms are the fucked things.
yeah, because imagine
It's
if you
the
make 500, yeah,
That's like the clearest math that's actually a scam, which kind of
right.
the more I think about it, kind of pisses me off.
Yeah, I feel
Well,
like
that's
this
why
is
it's
just
simulated, right? So they don't have to
yeah.
file with the SEC and you can't and skirt around regulation. That's the whole reason they're simulated.
Yeah, because I also think it gives
I didn't
access
even
to
know
like
that.
certain derivatives you wouldn't get access to if you're 18. So 18-year-olds look at like, oh wow, 50K. Oh wow, I can trade these things I can't. Only $100. Let me go for it. They don't look at the math. I feel like 99% of the conversations around prop accounts, or actually every single one, is like, hey, do you know how math works? And they're like, no. That's literally what they'll explain it in many more terms, but
It seems like a pretty simple regulatory step. Like
Yeah.
Yeah, but that's crazy that that's the case.
It's like, do you know
Yeah, I
you
mean,
know you're like,
they've
yeah.
so many consumer protections to like not get involved in high risky investments, but they
Yeah. Also
have it on
like
prop
your
trading.
yeah, also like your expected value of prop trading is negative 10%.
Which actually
Yeah.
I'm not against, like, to be honest, like I think
Yeah.
that facilities that even are like
Mhm.
just with like zero EV strategy not in your favor, I still think like people should have access to those. So I'm not saying that we should.
No, but I'm saying is like because it says it's a zero EV with like your prop firm account strategy because you don't have an edge. Because they take 10% off the top, your EV is always going to be negative 10%. Does that
Well, I think
track
it's
or?
worse because like you're taking this evaluation. I
Yeah, I'm
think
not counting the eval because there's like variance. I'm just saying like purely off like the 10% payout. Let's say you pass your eval, we don't count that. But anyway, Nathaniel, or are you there? Or I'm not sure how you
Yeah.
pronounce your name, but
What
how
up,
old are
bro?
you?
It's
Hey.
Nathaniel.
Oh, Nathaniel, how old are you?
27.
Perfect. Go ahead. What's your take?
Bro, honestly, I feel like um when it comes to school,
Okay.
we become a little, I don't know if the word is
Mhm.
subjective or objective, because we think that failing or like being a C plus student is bad, but in my opinion, I feel like in trading it's not about being right, but
Mhm.
it's more about being profitable. Like there are traders that are like 50% accurate in their trading but are still making a buck to this day. And I feel like the way to do that is to start messing around with your risk reward. Like I feel like the market does truly have an edge, because if you look at the charts, like let's say you look at a chart in a day, you see that there's like some structure going on in the market. You see there's trends that form, and you could actually
Yes. That's
make profit out of this. But
well.
as you're catching these trends, you could also be wrong. But just because
Mhm.
you were wrong doesn't mean that, oh, you lose your prop from, like
Oh,
you
I
got.
get what you're. Yeah, yeah. Because let me touch on that. I understand what you're saying. I'm not saying you can't go in with a strategy that has a zero EV and not make money. It's possible because all you're doing then is you're just getting lucky with EV. Does that or variance? Does that make sense?
Yeah.
Yeah, because like imagine there's a parallel universe and it's the same day. The stock can go up 5%, it can go up 3%, it can go up 2%, and these are all parallel universes. It could also go down 2%, right? The trader with the zero EV strategy in that day that makes money is just the one that's in that parallel universe where the stock went up. Does that kind of make sense?
Yeah.
Yeah. So you're not actually like showing your strategy having a positive EV. You're just getting lucky with the variance, which is what I think a lot of these so-called like traders and everything like where they're winning is just getting lucky with the expected value or sorry the variance, not the EV. So
Yeah.
you can have yeah, like for
Yeah.
example, like a say a slot machine, right? Slot machine, if you play it a million times, it has a negative EV, meaning you're losing money over the time. But you can make money playing spinning a slot machine. It's just like you don't have an advantage there. You're just getting lucky that because there's variance, you make some money before you end up losing it in long term. And if you can step away from it, then yeah, you would pocket that, but you would have to get lucky with the variance. You're still gonna lose money because it's against you long term. It's
Yeah.
just how lucky to get with variance.
Yeah, I mean, I believe that too, but I feel like when you come to this risk reward, you don't lose money long term, because every time, that like if you set yourself some parameters, I feel like let's say
Yeah.
you have a 50% win ratio, right?
Hmm.
But
Yeah.
when you're right, you take 5, right? And
What
when
does that
you're
mean?
wrong, you lose 1, right?
Oh, okay. Yeah, yeah. I see what you're saying, but that doesn't actually change your probability of winning. It doesn't change
It
your
does, bro,
probability
because
though.
when you like, let's say you're literally
Mhm.
50%, bro. Like that's
Mhm.
that's that's I don't know. I don't think that's the best trader you could be, but 50% I feel like is obtainable. So like, but let's say you catch a good edge that whenever you trade, you are actually able to get 5, and you're when you're risking 1, like I feel like that way you could actually
Oh,
become.
I get what you're saying, but here's the issue with what you're saying, right? You're risking one to get five, right?
Yes.
But if you have, say, a less than 20% chance of getting that 5, you would still be losing money. Does that make sense?
Yes, if you have a 20% win rate, of course, but that's what I'm saying, you know, like that's when you
Wait,
got to
hold
start
up.
coupling.
But that would make you the richest man on earth. So you're saying you would have an expected value of 2.5 because $5, or sorry, 1.5. $5 times, you said 50% win rate, right?
Yeah.
So that means you win 2.5, but you bet $1. So, more or less, you're winning, right? Like 1.5. That's you get a 50% return. That's your expected value.
Yeah, like every time you risk, I guess, $1, you get 2.5, right? In the
Right,
long
or
term.
Yeah, I
or
mean,
no,
you
no,
are
it'd be like 1
stipulating
point. Yeah,
you're
yeah,
stipulating profitability for sure. But the other like sort of important
yeah.
thing to
That would, but that would
consider,
make you the richest man on earth. Because if you did that, like say, a couple thousand times in a row, that would make you like billions of dollars. Because you would get $1, then you would get like
Yes.
250, then
Yeah,
yeah, like it would compound to infinity.
and I feel like that's the point of prop firm trading, which wasn't around 10 years ago, let's say, bro. Like 10
Yeah.
years ago, you could actually like you see the trading platforms, bro, like 10 years ago, it was like literally flags and like there wasn't even charts, bro. It was like taking charts, bro. You know, like
but that
Yeah.
doesn't have anything to do with prop firms. So like
ye-
you're just
yes, yes,
you're
bro.
just
Because
no, you're just
back
stipulating.
then,
Hold on. You're stipulating that your strategy itself is producing a 5x return each time, I guess, right? And or not a 5x necessarily return, but wait, what were you saying that your
yes.
It
risk,
would be like a
So
2.5 or 2.5x
whatever
return.
the case may be.
Yeah.
The other important factor would be to obviously like sample size, but comparing that to what the market itself is doing in terms of its risk to reward or standard deviation.
yeah,
And so
let's say
like
what
for
I'm
instance,
trying
if
to
you like traded 5 times and you risk the same amount that or so your variance was exactly akin to the markets, but you made the same return as the markets, like you don't have any strategy there. Maybe you made more than the market but took on more variance, you still don't have a strategy. So but like you're kind of like necessitating by what you're stipulating that you're like that you have alpha, which is fine, but that's just not the case for most people.
Yeah,
Yeah.
I know it's not the case for most people, but that's because people that are trading, they usually aren't okay with taking a loss. You know, like people don't want to click out whenever, like, let's say we're talking about 5 to 1, right?
No, but
Let's say when people get to lose that one, people don't want to click out. You know,
Nathaniel.
and that's not the problem with the prop
No,
firm.
but Nathaniel.
Yes.
Nathaniel. You do realize whether or not the stock went down 1 second ago doesn't actually influence if it goes up or down the next second, right?
I mean, what do you mean, bro? Like there are trends
No,
in
because
the
you're saying
day.
like but what you're implying is a trader looks at their account, they see a loss, and they don't like that, right?
Yes.
So you're implying that is it going to continue to go down? Is that what you're implying? Or
No, I mean, like you don't necessarily have to not like when you lose because you are actually like following a plan. You know, like every trend. Like let's put an example, the pound chart, right? The pound
no, but let's just take it. Let's just simplify it. No, I just want to use your example because you were saying that the trader they don't like seeing losses, right?
they don't necessarily don't have to like it, but because you also gotta believe, like you gotta be grateful that you lost too, because that's your opportunity, bro. You know, like when you take a risk, you lose.
No,
Okay, like you gotta know like how much you're gonna lose, bro. You know, because you know that same risk, the next trade is gonna give you back 5 times if
no, but
that's
like
your strategy.
but Nathaniel. No, but Nathaniel, the past doesn't influence the future. When do you get that or no? Because what you're arguing is like, oh, you lost one, you're gonna win the next one, or because
No. I'm not saying you will win the next one, bro. Like still a possibility, you know. But like it all has to be in your risks, bro. Like if you have a 50,000 profit account, right? Let's say,
Yeah.
right? Your risk is like $3,000, I think, and then you lose the account, I believe, right? So you as a trader don't have to go in today thinking that, oh, I'm gonna lose $3,000 today. You know, like if you lose it all in one day, like you're not doing right as a trader. You know, you're actually gambling. Like you say, Like
So
you
say
say
again.
in the slot machine, like you are gambling. You know, you're better off going to the casino if you are gonna lose everything in one day, bro. You know, like
What? No, but you don't have to lose everything. No, only thing when I say the slot machine thing, all I'm saying is when it comes to like these strategies that a lot of these guys are describing, all you're saying is I'm spinning the slot machine differently than someone else. You're not actually like describing a legitimate strategy that works. You're just getting lucky that the slot machine gave you a win instead of like actually, you know, doing something different that wouldn't be like spinning a slot machine. Does that make sense or
yes, it does make sense for someone that wouldn't know like what the market is about, which, like you said, is 99 percent of the people. You know, like it's like you said, like only the market makers know like um where they're placing their sell limits, their buy limits. You know, but there are there in the market when you look at the charts, bro. Like when you see a chart going up, it's because it's filled up with buy limits, bro. You know, like it's not because there were sell limits in that uptrend. You know,
I see what you're saying, but then you don't. Okay, sorry. Okay, yeah, of course that's true. If there's more buying, it pushes the price up. Yeah.
yeah. So like, if you start studying like a price action, bro, like just price action by itself, bro, every day you start noticing that it's not random. Like the pushes, the buy limit orders, and the sell limit orders, like
Yeah,
constantly.
but here's the problem.
You're
Here's the
getting
problem. Wait, but real quick, here's the problem. Like, just in that simple little example, like you don't know why those buy orders are on top of where the current price is, and like when it's pushing into that, it's further bidding up price. It could be because of a short squeeze. It could be because of like effective like investment. Those can differ wildly, and if you just like look at oil price, like the oil chart,
Also,
I think
can I
what was
say
it
something?
Friday when we saw like a squeeze up,
I think I
and
can
then
explain this a bit more simply, but yeah, basically, Nathaniel, what you're describing is saying like, hey, I'm gonna look at how many people are buying, how many people are selling, and I'm gonna go off those numbers to predict what the price is, right?
Uh, no, you're because when you see the price action move, it's because price action is moving against the people. You know, like you're not looking at what the people is doing. You're looking at what price is doing. You know, like
Yeah, but you're basing that off like the buying and selling, right?
yes,
Right. So you're trying to predict the price based on buying and selling patterns, right? Or orders.
yes, bro. Which is not
Right.
like
But
like I said, it's not a 100% like
no,
win
but
rate
you
strategy.
are you ready for you know what I'm gonna tell you? Are you ready for this?
Yeah, yeah.
No, no,
Sorry, I'm interrupting you, bro.
no, no worries. It's okay because I just want to understand what you're saying because here's the thing. What you're saying is 100% correct, but there's only one problem. You don't have access to all that information. So yes, if you knew, say, X amount of people buying, X amount of people selling at these amounts, you can predict what the price is going to be, but you don't have access to that information to predict that. And that's, you know, what you're describing is true. You just don't have access to that information. Does that make sense or no?
I well like regular people don't, but like I mean I don't want to say I do, bro, but like there's ways to have access to this
No,
information
but are
as
you, no, no,
today, bro. You know, the
there.
technology has changed.
Well, there really isn't unless you've
yeah.
bought data center like next to where the trading firm's happening. Like your data is delayed by at least a minute compared to when the market makers get it. So they've already factored in the price into the bid ask
Right.
spread.
Yeah, yes, for sure, bro.
Also like
You're a
market
minute
yeah, but
late,
also like
bro.
market makers have special privilege, so they have access to, we'll call it like level 4 data, I guess, that
Yeah.
actually the general public legitimately doesn't have access to.
Yes, bro.
Yeah.
I'm not saying you're
So
gonna pull your orders like like a market maker, bro. But like you could pull your orders good enough for you to make a living out of this. You know, like
But no,
obviously you're not gonna catch the market at the right edge, bro. Where you press the order, it's gonna turn right away, bro. Like obviously it's not gonna happen like that, bro. But like you could be close enough, bro. You know, that's my point. You know, it's not random. Like when you see a low of the day, bro, it is a price. You know, it's not like a random price. Like market just not randomly like stop there because like like they just wanted to, bro. Like there's something going on, and that price, bro. You know, there are limits there sitting, bro. So like,
Yeah, we're saying
But
it's
you're saying a
impossible to
low.
predict that.
Yeah,
Yeah.
but the game doesn't have to be prediction of price. You could be looking for mispricing. So
How old are you, Isam?
I'm 29 or 28. Sorry.
But prediction of pricing would be the prediction of mispricing, right?
Yeah,
No,
that
no,
would
it wouldn't
mean
be.
that you found inefficiency.
It wouldn't be a prediction. You're not trying to guess where price will be in the future. You're essentially finding instances in price where it's incorrect.
Then how
That's
would you
the
know
only
it's
way you can make
incorrect?
money.
How would you know it's incorrect?
You can deviate from clear equal. So there'll be places in the market where trade is being facilitated. Yeah, it's performing its function, and then there's
Trade is
times when
being facilitated. Isn't trade always being facilitated by
no,
market
because
makers?
liquidity supply breaks down. Liquidity isn't a linear.
Market makers are forced to quote both sides of the book. What are you saying? It's always facilitated.
But the degree of liquidity being provided is fluctuating. So there's times when
Sure.
trade
Different
breaks
volumes
down.
of different asset classes, but like what?
There's times when trade breaks down. The market doesn't facilitate as.
How do you know when it?
efficiently as it
How do
should.
you know that it's broken?
You can see it in the order book. You can see how much volume is trading in the order book.
What? How so?
No, but wait. Sorry.
Yeah.
No, but you know what? Let me say something. I agree that most people are using arbitrary, just random lines and fitting a narrative around it, right? They'll
Using
make this.
using the order book.
explain, bro.
So let me break down what the market is. Its primary function is to facilitate trade and provide a price, right? There's a whole field of study around this. It's called market microstructure, and essentially, as long as the market performs this function facilitating trade, you're going to see a degree of order in how much volume trades, how the volume comes in. There's
How are you
various-
making that leap? Wait, so you're saying as long as market makers are performing their duty by
No, it's
quoting
not just market makers. So the market's structured in
Then what is it?
it's not just market makers that provide liquidity. You could place an order in the order
No,
book.
I didn't say that, but you said as long as liquidity is being facilitated, which I assumed you meant market makers quoting both sides of the book.
Right.
Because
Yeah.
how else would liquidity be facilitated or like market
Because
making?
in an order book, you have your market makers providing liquidity at the top of the book, right? And they have various frictions in doing that job. There's a risk of adverse selection and winner's curse. So if they're an order at the last, at the back of the queue, at the top of the bid, right? So you have your best bid, you have an order at the very back of the queue. If all the orders ahead of your order get filled, and your order is about to be filled, on that moment, your subject to something called adverse selection. So if your order,
Are you just describing how price moves?
no, what I'm talking about is these frictions that market makers are dealing with results in various solutions to deal with that problem. If they're looking at signatures in the order book that implies a move's about to happen based on their linear prediction models, they will remove liquidity. Liquidity supply will break
Their
down.
prediction models are not. Their prediction models are typically non-linear. It's not a linear prediction model.
Wait,
No,
Isam, do you know what linear
I
means?
can find you literature on it right now. They are running constant.
Isam,
They
Yeah,
hold
go
on.
in, bro.
All right, take care. But Isam, do you know what linear means?
Yeah,
What does it mean?
just constantly looking. So a linear prediction model is constantly looking at future information and incoming information
What
to make
linear means?
predictions. Say again.
That's not what linear means.
Linear, isn't it just equally distributed?
What do you mean equally distributed? I don't know what you mean by that, bro.
So you tell me what a linear prediction model is. Sorry.
It would just be the input scales identically with the output.
Yeah,
Yeah,
it's like
so
a consistent. It's
So
a
it's
consistent
distributed
like,
equally
pattern.
at each point.
A consistent value that it changes by, but price doesn't change by a consistent pattern. That's the thing.
It's a linear prediction model. Meaning,
That's not, what do you mean market maker? bro, just because the order book like could have like a
Also,
wild
Danny, I'm gonna let you down.
distribution. Market makers are really just making money off fees, and that's
Right.
like spread fees, and that's again why it's like latency strategy. But
Right.
they're also
Also,
offered data. They can see where certain like stop orders. They can see data that the
Yeah,
public or even
they
like
pay for better feeds. They
even
pay for better
institution.
feeds.
No, they don't pay for it. They're grant.
Yes,
It's
you
like
do pay for level.
no. Oh my god,
You
bro.
pay for
No,
level 2
I'm not
feeds.
saying no. Market makers are legally granted information that, like, for instance, hedge funds are not. So market makers have a special place where they're allowed to see resting orders that the general public is not able to see, like including institutions.
It's not
Also-
a legal. It's not necessarily a legally granted thing because you go.
By the
to
way,
a-
this is why there's like the what do you call it? The Chinese wall, like in banks, and
Yeah, to
Yes.
separate
whatever that's called.
ring fencing. It's called ring fencing. So a market maker will go to an exchange and they have
But anyway.
they're given by the exchange certain requirements, and for that they're given privileges to get it, and they have to pay for those feeds. You don't just get access to that data; you pay
No, it's
for
because
those.
it's because they're
You can go
specifically
on the
designed.
Go
to
on the
quote
CME
both sides of the
website
book.
and you can look at their
Excellent.
contract specification. Like you can look at their specifications. It's
Okay,
on
I don't think.
CME.
No, it's because they are forced to quote both sides of the book. So market makers are literally during
That's a
normal market
requirement.
hours are forced to buy and sell positions of any institution and any retail trader. They're literally forced to quote both sides of the book.
Also,
That's why
SM.
they're granted information that the general public's not.
Yeah, can I touch on something, SM?
Go on.
SM. A linear prediction model would be completely useless because there's literally no pattern in the stock market that is consistently linear. That would be the easiest thing on earth to spot. That would mean that the factor between the price changes is consistent.
Yeah, so by linear prediction model, this is my understanding of it. They're using incoming data in the order book to predict immediately ahead of price what the estimated value will be. So let me give you an example in the order book.
That wouldn't mean that it's linear.
It's just in the literature. As far as I'm aware,
No, that's not a market maker. A market maker is not making money off latency in that sense. They're making money off spreads.
Yeah. Also, like, yeah, I mean, a linear pattern would be like the easiest thing on earth to spot in the stock market. You could probably spot that from space. Like, if you spot a linear pattern in the stock market, and no one else sees it, and it's, there's enough liquidity there, you would be a billionaire in a week. Like, what are we talking about here?
I'm not saying there's a linear input that they're using to derive future
No,
value.
but even a linear output, like.
Okay, so ultimately, this is what they're doing. I can explain what the model is in essence trying to do. So you have your order book. You have an order book, and in that, because of their advantage, so their feed, it give them updates on a nanosecond basis, 1 billion times a second.
Yeah.
Compared to us, we're getting updates every 120 milliseconds, right? It's ridiculous. So in that time, they're able to observe cancellation rates in the order book, the likelihood of their position in the queue decaying, so the likelihood of market moving against them. There's even a model out there where they can look at the first amount of orders at any price level being depleted, and that's enough to signal to them that they don't want to be ahead of that flow.
They're
And liquidity
also
will vanish.
they're also privy to like hidden orders. So like when a company's performing like an what's the term, like an iceberg order, or there's a couple other different ways,
Yeah, so
like prime
that-
brokers, people like get people into the market, and market makers themselves are actually privy to that information, where like your normal order book, like from the CME, doesn't display potential orders, obviously. So again, like I don't know why you're saying that somehow market makers being privy to this information is somehow giving you some edge on the market yourself.
I didn't claim that. And my claim wasn't that. My claim was there's a degree of order in how the market functions. It goes from areas of stability and lots of liquidity to suddenly and very, very quickly, liquidity disappears and it induces very small mispricings. It induces very small mispricings where
But who's to say what the correct price is? What do you mean it's a misprice?
What's this
And
based
who's to
on?
say when liquidity's disappeared, bro?
Right.
Like,
What's the
what if I'm
evidence for
about to
this?
come in? I'm about to come in with
Liquidity.
$100 billion into whatever asset you're in. There's going to be plenty of liquidity. You just can't see it coming.
Yeah.
No, liquidity is your ability to fill that 100 billion. So you can be a
Right. Correct. So liquidity could potentially dry up or become wildly available
Yeah.
in a split second without you knowing.
You can't predict the
I
liquidity.
wouldn't know that. I wouldn't know. I'm not trying. Again, you're missing the point of what I'm saying. I am not claiming to try and predict when the liquidity will disappear. I'm just saying, as a result of adverse selection risk, market makers are forced to move out the way of incoming flow that will roll over their positions. Liquidity will go from facilitating trade to suddenly disappearing at the top of the book. It will not.
They're actually forced to stay in the way. That's why I'm saying quoting both
Not
sides of
at
the
that
book.
price. They don't have to quote
Yes,
at the
at
very
any
best
price. They have to quote both sides of the book. Market
Not
maker.
at the best price. You don't have to quote at the very, very lowest offer. You can quote 5 levels deep in the order book. Do you know that?
Yeah, sure. If you're
Yeah,
saying
exactly.
that
So the
in
point I'm
terms of
making stands. So the point, what you literally said is entirely irrelevant.
but
Yes,
then how are they
have to
moving out of the
quote,
way?
but they
When are they
by
forced to move out of the
removing their
way?
order, by literally removing their order and placing it higher. It's called cancellation. You can type it in Google
So
right
you're just saying, wait, so if you're saying there are other retail or institutions that are wanting to fulfill whatever specific seller or buyers in the market, market makers might not be involved with that, but how does that
now. Yeah, no,
tell you
that
there's
is
liquidity there?
that is not what I said. What I am saying.
I'm confused. Like, so what is the premise of your argument? I'm just confused. Like,
Yeah.
I'm so confused what you're even trying to, like, what your claim is.
I'm saying the market has a degree of order where it'll go from areas of stability to misprice, and those mispricings are statistically significant to fail.
Where's your evidence?
Are you saying that the market makers sometimes, like a complex hedge fund has asymmetric information, make a trade, and the market maker loses to the hedge fund? That does happen.
Yeah, it does happen, and that's called adverse selection. It's called basically there's
That doesn't mean there's mispricing, bro.
Yeah.
I'm not
Someone
claiming
have better
that
information.
that in and of itself isn't a mispricing, but if in that moment they add a premium onto their quote, it's called spread skewing. So imagine their quote was 5 pips wide.
SM, where's your evidence for this? You're just describing something, but where's the evidence for it?
Just because a spread widens, that doesn't mean the asset is.
Wait, there's 3 questions being asked. Can you give me 1 minute, please? So the person who's Tiki Torch, I can send you plenty of literature on this. There's a whole vast field of studies called market microstrategy.
But are you arguing that it's an inefficient market? Like, I'm just confused. Like, what?
Yeah, I'm arguing that the market is not perfectly efficient. It's impossible for it to be perfectly efficient in the first place.
But so is that actually your premise? Because obviously that's true.
Yeah,
no one knows the exact price, which is what we're trying to say. You say it's mispriced, but no one knows the exact price of something.
The purpose of the order book is to embed information. Everybody places their orders and it creates a price, correct?
Sure,
right? That's the purpose of the order book. So if in that process, imagine in that process where you're placing a quote and you have price setting power like a market maker. And in this moment, you don't want to take on the risk of
price setting power.
Market makers have price setting power.
No, they don't. What are you talking about?
Not if someone doesn't fill the order. You can't set the price anywhere.
What the fuck are you talking about?
Bro, the quote is the price, not the order matching with it. A limit order is the price.
But they're only forced to quote where they're buyers and sellers.
That is price setting. The way price is set in the order.
No. That's demand has to drive that. They can set the price at somewhere that will never be filled.
Yeah, but SM market makers can't set the price themselves. It's just based on buyers and sellers. The market maker can't just.
The ultimate point here, and maybe I'm making it more complex than it should be, but it's like.
And in terms of the spread,
I hear what you're saying. There's mispricing in certain markets at certain times. All we're asking is like, how are you articulating that? Meaning, like, how are you seeing that misprice?
Okay, so I want to go back to a situation I was discussing.
But all you're saying is like you're seeing the mispricing when there's like less liquidity or something like in the order book. All this, that's nonsense. That doesn't actually point to any mispricing.
Okay, so
necessarily.
You know what it is? I've not been able to explain anything properly because people jump in with 3-4 questions. But just give me 1 minute. So I said, this is my premise. There's a degree of order in the markets where you have a tendency for liquidity supply to break down and mispricings occur, right? And I'm trying to explain the mechanism behind that.
Yeah, I disagree with that premise. Like, you're not saying anything there. You're saying,
I can show you. I can show you infinite literature on liquidity supply. It's not. It's very, very.
then can't you articulate it? I get you can show me it.
I'm still confused. Okay, yes, sometimes is there like liquidity constraints and like on small niche markets, yes. On the Nasdaq, on the S&P, like, are you saying like the S&P has liquidity constraints?
No, I'm saying liquidity isn't distributed linearly. No, it's not provided in the same amount all the time. It's changing, it's fluctuating, right? There's certain times in the market it's very vulnerable to volume-driven volatility. So if volume spikes at the right time and a market maker doesn't want to take that risk on, he will simply widen his spread and move his orders out the way as fast as he can. And it results in the top of the order book thinning out on one side, and it induces extra, let's say, jumpy price movements. In that jumpiness, in the way price is moving, you will see very, very thinly, very, very thin movements away from where trade was being facilitated. You can see how much volume is traded, and those moves are statistically significant in rebalancing.
Wait, just quickly, I'm curious. Do you think that volume is more highly correlated with volatility, or is less volume higher correlated?
Volatility is a function of available liquidity, basically. So if liquidity is not available at any single price level,
not true. No. So that's actually sort of what I'm touching at. Do you think that higher volume, higher participation in a market equals more volatility or less volatility?
if there's autocorrelation in flow, so if there's buying led by more buying and it's strong enough, you will get volatility because the willingness of the other side of the market to participate will disappear. Liquidity will disappear.
Dude, what do you mean by then? I don't think you understand what volatility is. If there's buying on buying, it's probably pretty low volatility, right?
Immediately, if you spam an order, we're looking at probably different scales. You're probably talking about a long-term.
I asked you a simple question. Like, do you think higher volume, or like, for instance, some like market that has higher volume is more
not
prone to
describing like the
volatility?
driver.
Not necessarily, because so what constitutes and decides.
Like, hold it, but SM, I think the issue with what you're saying is you have like a fundamental misunderstanding, and you're describing it in a way which it doesn't function, and you keep like trying to like go back to this idea that
you tell me what I'm talking. You tell me what's incorrect about what I'm saying.
The way you're describing how like the structure of the market is incorrect, because what you're describing is inefficiencies in market makers due to like them like offsetting prices, like jumpy prices, which doesn't make sense because market makers don't really have control over the price at all. They just fulfill orders, and then on top of that, the driver of volatility is not.
I genuinely think you guys don't know how the market's structured. So the way price is set.
That's not an argument. That's not an argument. Saying you don't think.
Can I see something
Sorry, wait. Sorry, Tiki, you just said that my claim about how the market is structured and resulting in these various dynamics I'm trying to describe is incorrect.
And I explained to you why, because the market maker doesn't have control over the price. That's buyers and sellers. I'm explaining to you why you're wrong. You're saying, oh no, you guys don't.
You tell me who provides liquidity at the top of the order book. Which entity is out there quoting between, let's say, 5 basis points? Who are those people that do that at the top of the book? Do you know what top of the book means? At the very best prices. So if gold is at 1,000,
buyer and seller, that would be the buyers and sellers.
And who places those buy limit orders and sell limit orders?
It depends on the market.
Yeah.
But who are the primary people that do it? Who are constituted who have a legal requirement based on CME contracts to do that? That's market makers.
HFTs, yeah.
Market makers.
Yeah, but they're not the ones setting the price. They're just fulfilling orders.
But if there is a stack of orders provided by market makers and they suddenly if they behave a specific way, they have price setting power, don't they? They influence the prices. Of course they do.
Wait, oh my God, bro. Like, everyone influences the price. If you're just saying...
They have a higher level of... because...
Influence, sure. That doesn't mean they're setting the price, bro.
This is a very logical point. If they are the people... Bro, you won't even let me talk. You won't even let me talk.
Okay, if they are... No, but SM, here's the issue. You've been talking the whole point and you just refuse to accept that what you're saying is wrong, even though it's like...
They have price setting power. It's widely acknowledged they have price setting power. You know why? Because they are the entities most people match their orders with. They constitute most of the counterparties.
Hold up. SM, you do realize the market maker is not the buyer and seller, right? It's just the middleman.
No, a market maker is selling you of the liquidity. So if I market
Wait,
order
wait,
buy,
wait, SM, you've been
wait,
talking
wait,
for
no,
a
no, no,
while.
no, no.
Can I
You,
clarify?
wait,
Let me
wait, wait,
clarify
wait,
something
wait,
for you.
Let's
wait,
all
wait,
go.
wait,
Let's
wait.
all go.
A market
Let's
maker
go to
directly sells you the whatever you just bought if that's their order. They
They can't
directly
if
sold it.
hold up, they can't if there's no seller. They can't if there's no seller. You do realize that, right?
I think you genuinely don't know how
Well,
the
wait.
mechanism
Just let me
that forms a
reframe it.
price. What's the
Let me
mechanism that
reframe
forms a
this.
price? Wait.
SM,
What's the
SM,
mechanism
I haven't.
forms a trade in the market? Can you tell me
SM,
that?
no. You're not going
SM, can I
past
just
no.
say one
Go ahead, son.
thing real quick, and just want to know if you agree with this? Rather than maybe saying they have price setting power, can you say they drive the price discovery process?
Yes,
Right? They're
that's
like a broker in between. I think
that's
that's what we're
entirely
getting
fine.
hung up on.
You know what
They
it
don't
is?
actually set the price, right?
Yeah, they
But they
can't do
do
that.
facilitate the market, which
The
no one
higher
disagrees
you
with, which is
But
why
for,
I'm confused about this bear
wait, yeah,
argument.
but Suk, wait for 1 second. Wait for just ask some simple question. Someone's trying to sell something. There's no buyer. Is the market maker? You're saying the market maker is the buyer in that circumstance?
I think you're making a
It's a
you're
yes or no.
mistaken.
It's a yes or no statement. Yeah, is it
If
the?
somebody's trying to buy something, he's just
Oh my God,
a
that's not what I
prospective
asked.
buyer.
No, that's not SM. Simple yes or no answer. Are you saying the market maker is the buyer or the seller for someone when there isn't another buyer or seller? Yes or no?
What the hell is? I genuinely don't
Yes
know what
or
you're
no
saying.
question.
What are you saying? Genuinely, what are you saying? Is the market if no
Hold
trade
up.
occurs, how
Okay,
could
I'll
there be a
repeat it
buyer or
again very
seller?
simply. Someone is trying to buy or sell. There's no other buyer or seller. Are you saying that the market maker is the one buying or selling when there's no one else to fulfill that order and setting the price the way that you're describing it? Yes or no?
I'm genuinely, I don't understand what you're saying.
This is
How
the
can there
issue
be?
because you
How
don't
can
even
there be?
understand what you're
Wait.
saying.
How can there even be a trade constituted if he's just wanting to buy? Where's the market maker? Like, where does the market maker
Because
come into that equation? If he just wants to buy, he's just a prospective buyer. There's no
no, but
trade
SM,
that's formed.
that's what I'm asking you because what you're saying is the market maker, you're saying the market maker is the one setting the price. If they're the one setting the price, does that mean when there's no other buyers or sellers, they're the one going in there and setting the price? Because that's what would give them price setting power. Yes or no?
What sets the price is the best bid and the best offer. That's it. That's what sets
Right.
the
So
price.
that's not the market maker. That's the buyers and sellers.
But what do you even mean? Wait,
What are
what do
you
you
talking about?
hold
You
on?
know,
So
this
what
is
do you actually
wait.
mean?
This
Can you
guy.
articulate? Hold on. Can you articulate what you mean by the best bid?
Okay.
Yeah.
So if I have a phone and I'm
Mhm.
trying to sell it, right? I want to go out to a market and find the best buyer for it. So someone offers to buy it off me for £100. A guy offers to buy it for 150. Another guy for 200. The best bid is the highest bidder. The way the order book works is it takes all the available orders in the market and it organizes it in a linear way, in a numerical way. The highest bidder becomes the best bid, and the lowest offer becomes the best offer.
What if there's what if there's 100 people that are trying to sell that phone for
At the same
$5?
price.
No, for $5 less. What's the best bid in that case?
That's the offer. The seller is not a bid.
Or sorry, what? Yeah, sorry, I spoke there. What's the
Yeah,
best
so
offer?
whoever had the lowest offer becomes the best offer. And that's what market makers compete to do. Their job
Okay.
is
What about vice
to
versa?
provide the price.
Okay, what about vice versa? So what if like you are selling a phone for whatever amount of money and there's 100 people that are selling it for $5 more?
Yeah.
So what's the best offer at that point?
If I'm the lowest offer, I'm the best offer. But in terms of it would then depend how much volume you want to buy.
Yeah,
but whoever is the lowest
in a split second, then like your order would get filled right away, but then the price would jump up right
exactly.
to
That's how the market works. That's how price is set.
correct. And the market maker is, if there's no other counterparties to that, the market maker is forced to fulfill that, correct?
No, they could remove. It depends on whatever latency advantages, the very specifics to that.
That's what it means to quote both sides of the book. So they're forced to take on that.
No, that's not true. That's not
That
true.
is
If they were quoting at
What do you
5, you know they
think-
can cancel their order on quote at 6. You do know that, right?
Wait, what do you think quoting both sides of the book means?
Hey, listen, I'm not claiming they don't quote on the both sides of the book. What I'm
Go
saying
ahead.
is they can move their quote. They literally move. The cancellation rates are one of the biggest signals about impending moves. It's a
don't
subset. Meaning,
There's
Wait, hold on.
still
Wait, SM, are you SM, are you claiming that the market maker can just decide to cancel trades for whatever arbitrary
not
reason?
cancel trades, move out the way of incoming order flow because they don't want to take that position.
yes, but we
So
stipulated that there's no other order flow. Like when you're legally contracted to quote both sides of the book, that's what that stipulates, and that's the risk that the
yes,
market
mate.
maker's taking
Mate,
on.
listen, they can quote both sides of the book, but let's say
They have to. They're forced to.
yes,
Yeah.
I know, but that does not mean they have to keep the order at the same place in the order book. There's two very
No,
different
it just
things.
means they have to fulfill where the bulk orders are.
No,
Yes.
that's not true.
How so? What?
That's not true. Just because they have to quote doesn't mean they have to have the 100% fill rates. They can move their order out the way. That's the most reason they wouldn't survive. They wouldn't even be able to perform a single minute of trading if they
The
weren't able
order,
to cancel their orders.
They make
no,
money off bid-ask spreads, so they can, because they make money off what they're doing. So how would they not be able to survive? What?
Yes. So
we are
if
kind of
I'm
getting lost
if
in the
I'm
sauce here.
constantly
I guess
if
our
I
question is
quote
like,
wait
how
wait
does this
wait
pertain? Hold on. How does this pertain to like a strategy that you formulated
Yeah.
whatsoever?
wait you lot just asked me two questions. Can you give me a minute,
Yeah,
Scotto?
sure. Yeah,
So
yeah.
if their job is just to capture a spread, how do they deal with the market moving around? How do they then so imagine the market's stuck in a 10 basis point range.
Latency, or lack thereof. That's how they deal with it.
Wait. If the market's stuck in a 10 basis point range and suddenly volatility expands and it moves higher 1%, if the market maker didn't adjust to that, he's now holding positions 1% down. He wouldn't survive.
No, the fact is they're getting information about
Oh, so you
fundamentals.
see how A-bands won't A-bands. You're trying to
All
sell a 4K mentorship and you don't know what alpha or beta is. Why are you in chat trying to make this argument?
who
Seriously,
me?
guys. No, A-bands in the chat. No, not you, Yasin. You're fine. Don't worry. I know, like, don't worry. But like, A-bands was like up on the other night. He's like talking about selling a 4K mentorship course, and this guy couldn't answer what beta is. But anyway, sorry. Go back, Yasin.
So,
Yeah, look, so
SM,
you
because
just said latency and awareness of fundamentals is why they can move out the way of incoming order flow. Not all incoming
bro,
orders.
what do you mean move out? Why do you keep saying move out of the way? They're the ones that are privy to knowing where order flow is going to go.
Oh, so you're basically saying they can predict where and exactly how much volume is going to come in over the
Better
course of
than
the
any,
day.
yes, better than anyone else. Yes.
Yeah. So the linear prediction models I was on about, that only gives them the capacity to guess the next tick. And they can't, that doesn't even compensate them for the fees involved with trading. So they can't even predict the future. They can only
You
predict the
think
next
it's
tick.
not? There's no way it's a linear prediction model. It has to be non-linear.
Yeah, there's
It isn't.
pricing. Yeah,
I don't
not a
know what
linear
you.
model would be like so easy to
Yeah, but
spot.
again, we're getting caught on
I
semantics
think
of
wait, hold
definitions
on.
of
No, I
words.
think a really
It's stuff you're
simple.
saying, dude.
No,
It's
but
like
I
a
think
really
you
wait,
guys
hold on. A really simple way to
totally.
look at this is right. Like everyone is trying to. We'll just like say we just have a market for one company, right? Everyone is trying to have a price discovery advantage on what this company is valued at, and market makers are getting that. They have asymmetrical information, and that's the idea
How would
of
that? Okay,
them
so they
being
have
able to
information about what the value of that.
them being able to create an arbitrage, like an actual true arbitrage with a 0% risk in terms of making money off a spread. And like Song pointed out, there are absolutely times where they're losing money, but the idea is because of the
You'll be surprised. You'll be
asymmetry.
surprised. And let me tell you something. So, do
Okay.
you guys know what Sharpe ratio is? Risk adjusted returns.
Yes.
Right. So, if you look at some of the best market makers, they're basically HFTs, the non-bank HFTs that have really good high prime broker relationships. Basically, you look at their returns and you get Sharpe ratios of 14, 15. These guys do not take, the best market makers do not take really significant losses. They do not hold on to risk. So the point I was making,
Because the asymmetry in information. Correct.
yeah, and that asymmetry comes from various speed advantages from their hardware and connectivity, but also
latency. Correct.
Yeah, all right, okay. So the point I'm making is their revenue model is getting a risk premium for providing liquidity in the order book.
Uh-huh.
They can only do that job if the market is relatively stable. If the market moves against them 1%, they have to go into a mode of avoiding trade. They cannot just step in front of it and facilitate and
Hold up.
hold on to
But
risk.
hold up, SM, you realize they're not taking a position, they're just fulfilling what the orders are.
Matey, by fulfilling the order, they take a position. Do you not understand what I mean?
No, but like it's
I know
the
their
opposite.
strategy is delta neutral, so they have a delta neutral
No,
strategy.
but
For them to
SM,
fill an order,
SM,
that's a position.
SM, for them to take on for them to take on a thing like a trade, right? That means there's a buyer and a seller, so they're not actually taking a real position. They're just the middlemen.
And
But
here's also the wait, hold on. Here's
I
also
think
some what you didn't mention. It's not their Sharpe ratio really that matters. It's actually their alpha, which what signifies their beta neutral return. So you just mentioned the market moving 2%. Well, their return's driven based on like beta neutral axioms. So
Right.
in large part, it
what does
doesn't
that
have
mean?
anything
Sorry,
to
was beta neutral?
meaning their strategy is not moving with the variance of the market. So when the market moves up 2%,
Yeah.
that doesn't necessarily mean that their return is going to move akin to that whatsoever.
Okay.
Or better put, that they're going to make 2% every day, regardless of where the market goes. Like that's a very clear example of beta neutral. Like 2 days of them making 2% and 1 day or 2 days of the market making 2% and negative 2%, the beta
Yeah.
would be zero. That would be beta neutral, meaning their returns aren't, at least in a simple model concept, aren't
They're not linked
derived.
to the market's returns. They're
Exactly,
independent,
correct.
basically.
Yeah,
Okay,
exactly.
cool. Yeah. So the overall, I think Tiki misunderstands what I mean by some of the phrases I said. So when I said take a position, if a market maker has a bid and someone market sells into that bid, that's a position. That's literally
Yeah,
a
but what I'm
position.
saying you is that position is going to be like held for like 0.1 second, and it's never going
Not
to be held
necessarily, yeah, but
unless
it's
there's
still a
someone else at
position.
the other end.
And this is the exact point. This is the exact point I'm trying to make. If in that
Mm-hmm.
0.1 second the market moved against the market maker, right? Is he not now holding on to a losing position?
What? No, but hold up.
Yes.
No, but like yeah, but that position's only going to be held for like 0.1 second, and it's just going to be off
No,
put
but
to the next guy.
wait. Answer my question.
But
So
but
you have,
SM, well, yes,
you have
I'll answer it. Yes, you're correct. But you're talking about like black swan situations where like
no,
it's
not
all full on.
necessarily.
Well, it's like, can I finish, please? Like a full on sell off. If there's no buyers for it anymore, right? And everyone's just selling, and that's the market maker is going to be a lot of risk because everyone's just selling and they have to hold it. Or like if they have a breakdown in their server, right, and they don't get the information before everyone else, so a hedge fund has better information than they do, and they make a block trade on it. Those are the instances where market makers like fail. Are you
No, but
saying
they're also
outside
not
of
even.
black
They're
swan?
also
no, but
built
wait,
into the regulation. They're in
wait.
those extreme, like sigma moves. They're not forced to quote. There's extreme circumstances where market
Yeah.
makers don't have to
I'm not
quote
on
those
about.
sorts of
I'm not on
things.
about like flash crash breakdowns in the market. What I'm talking about is they have an order at the best bid. Agreed? Okay, that's just what we're talking about. There's an order at the best bid, and someone market sells into them. Now, 1 second later, another large order comes in and he wipes the best bid out. So now the market has moved one tick lower.
No, but SM, you
Wait,
do realize
wait,
that
Tiki,
wait,
Tiki.
SM,
Okay, go
you
on.
realize that this is happening so fast that it really doesn't matter. Like that would have to be a black swan
Literally
event.
matters. And they probably invest tens of millions of fucking dollars into avoiding being in that position. Just literally avoiding being in that position. That's why they have the latency advantage I'm talking about. But let's get back to it. So in that moment when the market just moved one tick against them, it's literally them being subject to adverse selection. They can't make money if that continues to happen. You know what that means? Someone was more informed about the true value of the market than what their order implied.
No, that doesn't, because that's necessitating an efficient market, which we already stipulated. It's not a perfectly efficient market.
Yes, but we know it's not perfectly efficient. But
So
if
then
I
what you
provide
just said is
wait,
nonsense.
It's
This
not
has been so
nonsense because
circular.
if I provide you a bid and an offer, wait, let me finish now. If I provide you a bid and an offer, the mid price in between that bid and the offer is my implied valuation of that market. That's the exact point of providing a bid and an offer. I believe the market won't move past these two areas. Now, if the
Except
market,
for a market maker is not trying to ascertain price discovery.
Right. Yeah, that's
their
part of
whole
your
job to be able to provide liquidity, you guys are fundamentally misunderstanding the risk associated with it.
SM, this is like literally going
Wait
around in
till-
a circle.
Yeah, because you guys are
No,
incorrect
because
about what
you
the
don't
market makers
understand. No,
struggle.
because no, but you
We're
know what
saying
it
we
is,
said
SM?
exactly what you said like 20 minutes ago.
Yeah. Also, SM, I think you don't. I think the problem is like you have like your own stipulation about how the market works that isn't
It's
true,
not
which
mine.
is like
Mine looks at market microstructure. There's a vast field of study on it. Everything that
SM,
I've talked about, from
SM.
adverse selection risk, the markets cancelling their orders, moving out of the way of and liquidity supply disrupting. Every one of these is a well researched like subsection of market microstructure study. You can go on Google and check it yourself.
Yeah, I'm not disagreeing with that, but what's your point?
Yeah.
The point I've made at the very start: liquidity supply disrupts, and the market is vulnerable to moving away from areas where trade is being facilitated. Those moves away are. You can even look at the Bank of International Settlements. The Bank of International Settlements did a study on this. They looked at
What
data.
makes them? But bro, like again, you're not actually articulating why you think the market will move away from a certain price.
I'm saying there's a
Is it just
tendency.
because the order book? Is that all you're saying?
I'm saying there's a tendency for liquidity supply to break down and incoming volume to cause
Where is it?
disruption.
No,
So
but
if
what
if
are
Not
the
saying
factors that go in?
anything.
Yeah, but like that doesn't. Oh no, but SM, all you're describing is an event. You're not saying like why or when that event happens. You're just saying, hey, this event happens, but you're not describing like when it would happen, or you're saying
it's a feature of the market, and I'm describing. So when it would happen,
when does it happen?
yeah, so liquidity supply can break down at any time. If there's a period of low volume overnight,
And what drives that? Like what event would drive that? Other than okay, low volume liquidity, but what are the
volume spiking, setting off this chain reaction. That's it. It will literally be just a volume spike, come from random entity. You can't predict when volume will come.
It could be the
If
opposite.
somebody
It
spikes,
could be a lack of volume, right? Too.
if somebody spikes the market order button and causes an influx of volume at a time where market makers do not want to take on risk, you will get spikes. You will literally see jumps away from where the current price is. Little trade is being facilitated. It'll skip over the level.
And it could be but it could also be the opposite. So if there's no volume and people are
Then how would the market move if there's no volume?
well, wait, if there's no volume and there's like only one or two traders, that's why volatility is more correlated with lack of volume. Because if you only have a
It's
couple
lack of
traders,
liquidity. It's lack of again.
yes, this is why small cap companies move far more.
You do know that liquidity and volume are two different things, right?
Well, actually, not necessarily small, but growth companies with less volume tend to move more than companies with larger volume.
Because
I don't think this is going anywhere.
Again, this
Also,
this is unrelated to what I was saying. You asked me when is this behavior?
I have a really simple.
I'm saying the opposite.
Okay, guys, I have a
You
simple
asked me when does
solution.
this behavior occur? I'm trying to explain
Guys,
it.
I have
It
a
can happen in
simple
the
solution
opposite
to this.
situation.
I have a simple solution to this. Can you name me a stock price, like name me a stock and a time where this occurred? Just nice and simple. Can we examine an example of this occurring in the market? Give me a date and time. Just simple. Like, I don't know. For example, Apple, March 3rd, 2005, for example. Like, is there an example of this happening? Or is that fair to ask? I could just so I
Yeah,
can
well,
see.
I just don't know when there would be like he's talking about over the counter markets or something like that. Like it makes sense, right?
I
But like those are the market make.
Yeah, but
Go ahead,
like I
Mark.
don't understand how he's
to jump
yeah, but
in,
the
I
point.
think it could happen when a lot of orders are one-sided. And that's the
Yep.
problem. It would cause the spread to widen for a second, but I imagine
We
it
flagged
getting
that to him.
I imagine
so-
that getting arbed out very fast as like dealers are on the market since market makers sometimes are the counterparties depending on how the order books are structured, what are the best bids and prices. If a lot of orders hit the ask or the buy, I imagine it like spreading widen it, but arbed out in a few seconds.
But also
In a
like
sell off, I could see when it would happen.
yeah, but then also like what does this have to do with like the price being? I guess the inefficiency would be the arbitrage opportunity, but like I imagine that would get eaten up right away before you can even have a strategy around it.
Like the
Like,
sell off
he
would only
just-
happen if like a
my problem-
massive order was made.
My problem is like when he's like talking about microstructural models, which are very like specific to like HFTs and MFTs. You really can't develop a quote unquote like microstructural model without like billions of dollars worth of infrastructure, or it just being like this like pure price based or volume based model. And at that point, you need to apply a whole lot of mathematics to it. So you need a bunch of PCs or
Yeah,
at
but
least a bunch of ODs. And other than that, you don't like. There's no conceivable advantage in terms of like microstructural modeling
ABC, what are you
whatsoever.
saying, ABC? What is ABC saying? I am extremely low IQ. I do not know what I do not know, or that I do not know nothing.
Yeah, I'm just a very lofty person.
Scott, what you just said, you're essentially right that most. I'm not talking about developing a microstructure model. Microstructure is just a study of how assets exchange. That's all it is,
Yeah,
right?
no, I know. And that's what I'm saying. Majority of microstructural modeling comes down to latency.
And hardware, etc. Yeah, I agree. The point. All right. So
Well,
what happened is.
the hardware is what leads to low latency.
Okay, yeah, we agree. So and the connectivity with the exchanges, right? So BIS, the Bank of International Settlements, they did a study on who supplies liquidity when when stock. Wait, let me just finish your point, please.
No, because I'm tired of this. Because you've been on about this for like an hour plus now, dude.
Not an hour.
I don't.
No.
You seem to be like arguing for no reason.
Explain answer Scotto, who said we can't model a trade model around it without having the hardware. But you weren't listening.
Because you've been like going on about like it's very circular.
You come in with 3 questions every time I'm trying to explain something. So Scotto, they did a study on French stock traders and they were trying to find out who supplies liquidity when. They basically found that market makers have limited risk bearing capacity, so they don't like holding on to positions, right? And at times their ability to provide liquidity was constrained, so they would not wait at the best prices. They would literally remove their orders. And there was other entities with better risk bearing capacity that would trade into price moves. They were generally HFTs, they were generally hedge funds, they were informed flows that would trade into these moves and actually hold on to the risk and provide liquidity for these disruption periods. And when do these periods occur? It's literally just a function of volume coming in at the right time, setting off a certain chain reaction, where the market maker will not want to take on that risk. That can occur at any time when there's a temporary period of illiquidity, a temporary period of uncertainty, or around an event. If I know jobs data is coming out, the market maker will literally thin out his box. He will literally widen his spread way before volume even hits the book. So
I don't know the regulations in Europe, but it's in terms of like America, market makers are forced to keep a certain spread, especially like in terms of like the CME. Market makers are forced to keep a certain spread, and again, like quoting both sides of the book, it helps obviously that it's like the most liquid.
Scotto, you know what you're saying, it doesn't negate what I'm saying. Yeah, they can quote on both sides of the book.
I just don't understand how you're deriving. And by the way, most HFTs, I believe, most market makers are HFTs, and vice
That's the only
versa.
way they survive. HFT is a very broad like term. In it, they have there's different strategies, right? There's latency arbitrage. There's what do you call
typically
it?
like you
Statistical arbitrage, etc. So there's many different forms of HFT.
Can we get to a point?
Go on. Sorry, Tiki. I was quite.
Hey, can I ask a question?
Yeah.
Sorry if this is really annoying, because I know it's really annoying when people ask this kind of question and you just jump in the middle of a discussion. But what's the core debate?
What?
What's the core debate?
The core
That's
debate.
actually what we're trying to figure out here.
Yeah, I don't know because it seems like SM had this notion that I guess.
The point I've been trying to make is that there's a degree, there's an observable order in how markets function. There's an observable order, and there's a tendency for mispricings to occur. You can call them quasi.
That's my problem. Like you're not saying how it's observable whatsoever. It's observable through PCs. Like the only way to me I could conceive of it being observable is through like differential, like certain types of differential equations or models derived from differential equations.
Sorry to be rude. Is that the proposition?
Yeah, because the
I'm saying it's
proposition is
observable.
yeah.
The proposition is that there is a predictable way in which markets function?
No, I didn't say predictable. There's an observable order that explains short-term price volatility. It explains
Wait,
why.
hold on. But SM, if you're saying it, if you're making the claim that it's observable, and
You
that
can
a
predict
market has a
parts of that.
tendency.
Yeah.
Wait, don't cut me off. No, hold up, Essen.
Sorry.
Essen. If you're making the claim that it has a tendency to go there, that would have to imply that there is predictive power there, because otherwise the tendency wouldn't exist if it's not predictive.
You can predict the behavior, but you can't necessarily predict the future value or what the true value is. So
So then what are
just
you
don't want-
predicting?
I don't
Wait,
want
what are you
people to
predicting then?
mistake. I don't want people to mistake like what do you call it? Mix up valuation
No, but
prediction.
Essen, hold up. I'm not asking for other Essen.
Don't.
Holy shit,
The
Essen,
point I'm
listen for
making. Wait, Tiki,
Essen,
listen.
listen for
Don't
3
mix up
Essen.
valuation predictions with
Essen,
behavior.
again, you're not actually you're going
That's the
again.
point I'm
Essen, this is the Essen. The issue with you is when I ask you something, you go off on 15 different tangents. When you're saying predicting this behavior, what are you predicting?
Behavioral like features in the market. It will
Okay,
volatility will occur at certain times. Path
hold up.
dependencies based on these
Okay,
dynamics.
got you.
Here's where we
Okay,
get to the whiteboard, Tiki.
right, hold up. Okay,
I don't
actually,
teach. I don't teach or sell anything.
oh my God, SM, listen for holy fuck, dude. I don't think you're trying to have a conversation. Like,
Go on.
do you realize what you're saying is okay? So what you're saying is you can predict behaviors, but you
Yes.
can't predict like numbers.
The valuation is something entirely different. Yeah. What the true value of an asset is entirely different to how
Okay,
it
again, I didn't
behaves.
ask true value of asset. Oh my SM.
I mean, actually, nowadays, now you can do that. Actually,
Okay,
What?
I'm following along with what you're saying. You're gonna go step by step, and don't go off another tangent. I want to drive home this point. You're saying that you can predict behaviors. Are those behaviors observable in numeric values of certain variables?
What does that mean, though?
Holy fuck! If you predict the behavior of like a market maker, where is that going to show? Is that in their volatility?
No,
Is that like I don't know whatever? Like is that in their like
I'm
some
not
order
predicting
flow?
the
Is that
behavior.
something like
Again, you're misunderstanding what I'm saying. I'm not predicting the behavior of the market maker. I'm saying all in all of these dynamics combined result in specific behaviors and features in the market.
and what are those
Price
features?
formation. In price
What are-
formation.
What are those numeric features?
What does that mean?
What
What do you mean
variables
by
are you looking
numeric
at?
features?
To see, what variables are you looking at?
Right.
Oh, yeah. So you're looking at trading data, basically, right? Volume profile.
What is the
order flow.
variable?
No, you were saying that the data generates order, and we're asking how are you quantifying that order other than
Yeah.
like
What is that order?
a
Yeah.
T-Rex or a pterodactyl?
you know what's funny is both of you are actually correct for.
I didn't say the data is generating an order. What I said is the market structure and design, and all of its participants combined, the trading technologies, the mechanisms for which trades form, the frictions and access in the market, and the
Develops
solutions
order,
to
right?
those frictions all results in an order.
Order, yes. So
What is
that's
that
data.
order?
What you just described is a whole bunch of data that
Okay,
generates order.
Okay, yeah.
And so we're asking, how are you
What is that order?
characterizing that order? How are you observing order? And how do you
What is
define,
the
like
data?
quantifying
Yeah.
that?
Yeah. What is that data?
Or what does the order look? I'm
And
just
then
how are you
and then
quantifying
trade
the
on
order?
it because you're saying it's mispriced.
Right.
Okay, so are you? My English isn't that good, right? So are you asking me what is that order and what does it look like, or are you asking
What is
Yes,
the
me?
and
number? What is the
and
yes?
how can we tell when it's not ordered appropriately?
Or just go with the first one first and foremost before anything else. But yeah.
So just looking at prices, you can tell, you can even see in the trades occurred, where trades being facilitated, and at times you have very sharp moves away from it. Those sharp moves, about 80% of the time, will mean revert back to where trade was.
Okay. So you're okay. Perfect. So what you're saying is you can predict the behavior of future prices because it has a tendency.
You can predict a series of events taking place and outcomes occurring.
my
Yes.
And my
God.
question is, how do you know that that sharp move in price
Able
isn't
to
due
answer it. He
to
doesn't know. He doesn't
a
know.
fundamental change in the valuation of that company? Meaning,
No.
like they have a what do you call it? The
Information comes out, earnings occur.
earnings,
An
yeah,
8K.
earnings call, or even just like the president announcing something that will change the or the Fed or like FOMC or something like that. How do you know that those spikes aren't due to like fundamental changes in the company's value rather than just mispricing?
You know, it's a good question. So what you see is the persistence and the flow. So if at this elevated mispriced price.
You're not like
Wait,
describing what
wait, Tiki. If at the mispriced price you're seeing volume coming in, accepting there, then that implies there's a change in valuation. But if at those elevated prices you're seeing trade not being facilitated, basically,
SM,
signal,
I want
you can
like a
tell if
one
there's
word answer.
persistence up there.
Or SM, I want a one word answer. I'm going to kick you because this isn't going anywhere. When you say the market has order or structure, what variable are you going off of? Nice. What variable? One word answer, please.
I genuinely don't understand your question. I genuinely do not.
Okay, so you don't even know that. You claim.
So, well, why are you guys debating something that's already been solved?
Oh my ABC. Wait for 1 second. SM, you claim the market has a tendency to follow certain patterns that have order. Correct? Yes or no?
Yeah.
What variable are you using to base that order? One word answer. Not a tangent. One word answer, please.
I don't want to seem like I'm fucking. I genuinely do not know what you mean by what variable are you using. And what do you mean?
He's saying if you have any conception of a predictability of the market based on the order flow, then there must be variables to account for that predictability. So what are you using to determine that predictability?
Thank you. Yes. Or multiple variables. Just name one. Name one, please. Just anyone.
You know what? I genuinely don't know what the fuck you're saying, bro.
How can you make a prediction without variables? If you throw a ball, you know.
But stop talking to me in this math language. Stop talking to me in this math. Just use normal English. Just use normal English. What are you saying? So
if you throw a ball,
yes.
Okay, you know the direction, the velocity, the speed of the ball, okay, and you know gravity. There are variables to account for where the ball will land.
Okay, yeah.
Okay? So if you're making predictions based on the order flow, there have to be variable factors which are taken into account.
Yeah, so I'll explain. If I see a set of conditions in the market where these
what are those conditions? One word, please. What are those? Like any variable.
Stability and dislocation.
That's not a variable. That's not a quantifiable variable.
Stability isn't a quantifiable variable, no?
No, it's too general. Stability can be
How are you
many.
quantifying it? Yeah. Is that standard deviation? Is that sigma? Is that volatility? What is that?
What?
Are you measuring stability? How are you measuring dislocation?
He doesn't know. No, this is the problem. These people don't fucking know what they're fucking talking about, and it's like it has structure and order, and this takes like 50 minutes because this guy has no. You guys don't know what you're talking about. It has structure and order. It has a tendency for this. What is that structure and order? I don't know what the question is.
Why are you debating something that's already been solved? Take your torch.
Solved? What do you? No. There's nothing here that's been solved or not. What he's making a claim.
It's already been solved. This whole issue.
What issue?
We have automated market making now, smart contracts. You can now have a predictability on the pricing.
Okay, that may be true, but what he was claiming was that there was some order to this market, this structure, this tendency, and I kept
asking. In a traditional order book, then no, there is no inherent order.
Yeah, I don't think I think that's true too because he didn't have it. He just wanted to seem smart, and the problem with these people.
Talking about a decentralized exchange, then yeah, there is.
My biggest problem is the market really. If there's any system to describe it, it's like a chaotic system, which is like a system. Like for instance, like weather patterns, or there's a bunch of other like simple ways to put it, but they're non-linear systems, so they appear to be completely random, having no order, but they're still in the background deterministic.
That's because of informational asymmetry. That's because of a lack of information.
Well, and so my point was when he was like sort of describing. I mean, maybe I'm like straw manning him here, but when he's like describing like linearity to like the order flow or whatever, and somehow that provides order to like his overall view of the market, doesn't really make sense to me.
Yeah, because if there's a linear pattern in the market, that would be like arbed out of existence immediately. Like if it's like there's no linear pattern. If it were linear, like that, you could spot that from space. It's so easy to spot that. You would be a billionaire in a weekend if you found some.
That's the thing. It all started as his premise was he can predict when there's a mispricing that the market makers and the HFTs aren't accounting for, which is all we wanted him to explain.
Also, like the part that he's really missing, the reason that I kicked him is because he knew he did not have an answer because he was just bullshitting. Like I don't think he understood what he was saying. It was like there's some order and structure to the market. How are you quantifying that? I don't understand your question. Are you accusing him of being an astrologer? He might as well be. Yeah, it's astrology because he doesn't know what he's doing. He doesn't know what he's talking about. There's structure to the market. What is the variable that there's structure? I don't understand what your question is like.
Yeah, the equation in the smart contract.
Okay, but at least you're giving a variable. He wasn't able to give a variable at all.
Well, it
That's the
wasn't
part
really a
that's
variable.
This guy didn't give a variable either. He just
I
said an
didn't give a
equation.
variable. I didn't give a variable.
I mean, yeah, but the difference is at least looking at that equation. The equation will have
You
variables.
agree you're pro crypto, right? Tiki Torch?
No.
No, yeah, you're talking about DeFi.
Why? It solved the market making problem. There is predictability in the contract code. So, you know.
Crypto has no value.
But that actually doesn't necessarily help market making unless that
It got rid of
codify
market
that
making. We don't
code.
need market making anymore. We have liquidity pools. We don't need market making.
Well, in what sense?
Who's facilitating the trade?
What do you mean liquidity pools?
What do you mean? We automated market making. Through
Right,
that-
so like just like HFTs work right now. It's just
Yeah, but they
codifying
have. But no, hold up. But
market making.
ABC, there's the ABC. There's crypto exchanges that so there's definitely market makers there. That crypto
Yeah,
exchanges.
so there's market making crypto exchanges, but those are a scam. Why would you ever use a centralized crypto exchange?
For price discovery.
I don't use centralized crypto exchanges. I just trade on DEXs.
Well, but even like, okay, if you're talking about like, and this might be sort of outside my knowledge here, but if you're talking about like some DeFi, maybe I feel like Sonk might have more knowledge on this, but if you said liquidity pool, so I'm assuming this is like some like codified market maker.
Right there, it's an algorithmic based pricing model.
Right, which is exactly how market makers work in normal, like non-decentralized markets.
There's a lack of transparency though about the units of.
But that's the point of like a market maker should have the veil of transparency. I think is beneficial to being able to make a market.
Yeah, because you have to know who's like buying and selling to be able to facilitate buying and selling.
And obviously, if the buyers and sellers, the true buyers and sellers, had that information, then the market would be susceptible to manipulation.
Right. And that would
I
like break
agree.
down the market because then
If
you
I
lose
remember,
trust. And,
I might be wrong on this, but didn't like a lot of DeFi exchanges like go bankrupt with like the
Yeah.
FTX crisis?
Yeah.
That was
Because
to,
they were-
that was to do with Terra.
Wait, that's so true. Actually, I saw that on TikTok. I'm not gonna lie.
That was an issue with a bunch of people doing like delta neutral strategies, and then the underlying asset collapsed in value.
I remember
Delta
looking at this a
neutral?
while ago, but I just recall that like it wouldn't actually. I would have to read up on it again, but I remember reading and
But-
hearing
but
a good claim that it wouldn't work for like
Yeah.
S&P 500.
Something failing is not evidence of it being wrong. It's an
Yeah,
evidence.
completely agree. But I remember reading there's a lot of problems with why it
Yeah.
isn't as efficient for the public equity markets. I would have to reread on it. It was a while
Talking
ago.
about.
No, I'm telling you, and I'd have to get more informed on it.
I have
But I
a
remember reading
question.
What
something.
you do is tokenize every stock and get rid of this antiquated share class system. It's fucking retarded. All
Oh
respect.
yeah, don't say that. I don't think you're allowed to say that. ABC, I'm sorry.
TikTok shop.
Yeah, I don't know. If it gives me a warning, I have to let you down. I'm sorry.
We just tokenize.
Yeah, but I mean that's sort of what I asked. Why, like, what you mean by a liquidity pool? Like, do you understand how it works? Because if you could
No, I'm
just
low
like
IQ.
simplify it.
I'm low IQ.
I have to let you down. I'm sorry. Yeah, sorry, ABC. Also, welcome Ham to trade. So
Hey,
how
what's
old are
going
you?
on, man?
How old are you?
I'm 30. I just had a quick question.
Yeah.
I commented earlier. I was just wondering, is it because day trading garners like a large percentage of people not making money that it's a scam, and then the percentage of people that go to college are successful that it's not
Well,
a scam? Or
Yeah, but I'll tell you why simply. It's because most of the people who are day trading, they go into it and they're effectively like you're going up against people and institutions that have more information than you. So you're quite literally putting yourself at a disadvantage. You're going into a casino and you're basically gambling, and most of these guys have no idea what they're doing. Like they don't
oh
have
yeah, no,
strategies.
you're
Yeah.
absolutely right. Yeah, for sure. Yeah, 100%. Okay, that's
Like Yeah,
I
I'm not saying
completely
like
agree.
yeah,
Yeah, yeah.
and let me clarify. I'm not saying like there's no successful day traders or it's not possible. Yeah, absolutely is. But like, do 99% of people have a statistically significant edge that is provable? No.
For
Like
sure.
that's rare. Yeah, that's what I'm saying. Yeah, I got you. Yeah, I'm not saying like it's impossible to trade something. Like no, but like if you're gonna be a trader, most of the time, like those guys, they go to college, they get degrees, typically math or engineering or something related, and they'll go and they'll work in a bank or they'll do investment banking, get a master's, or go work on a trade floor, something like that. They're not gonna be guys on like like YouTube, like oh this is how I trade and so and so. They're not gonna be guys and they're like 18 or 19, like unless you're a quant trader. But even then, like that's not really what I'm talking about here. That would be again like fall under the category of like legitimate statistical edge. That's all it just comes down to. If you have an edge, you're not gambling, you're going to be fine. You don't have an edge, you're at the mercy of market makers and variance and luck, really.
100%. Yeah, you're absolutely right. Dope. Yeah,
Yeah.
man. I just wanted clarification on that, and also, yeah, man, that's pretty dope. Cool.
Yeah.
Also, Scotto, what is your background, Tiki?
I worked in private equity. I have a finance degree, a business admin degree, and I did a minor in econ. I did 2 portfolio managements for my university, it was around $3 million, and then I'm gonna go get a master's in quantitative economics, and I did a consulting, and I worked in management for 2 medical companies before that for like around 4 years.
Also, like he knows what he's talking about as well. It's pretty dope. Cool, man.
For sure. Yeah. What's your background? Ham trades? I'm assuming you have like your own finance firm or you work for something like that or
Yeah. And I also like in terms of education, I got. Sorry, just give me one second.
So I'm gonna end the live stream soon. Drop a follow if you enjoyed, guys. But
Yeah, engineering and basically, math
yeah,
minor and all that.
Yeah, yep.
Yeah.
Yeah, you play as a trader because yeah, exactly. You have the background. Yeah, exactly. You at least have the tools for it. Because here's the thing, right? Ham trade. There's guys I'm talking to. They're selling things like someone was selling a $4,000 mentorship for trading, and I asked this guy, hey, you know what beta is for terms of like like a CAPM modeling? He's like, he couldn't answer it.
It's because like a lot of like normal technical analysis, they don't bother looking at the books. They don't know how to read the books. So
Yeah.
yeah.
Yeah. I mean, I get that, but at the same time, like if you're gonna be selling something finance related and you don't know your like finance 101,
Yeah, that's crazy. To not know
Yeah.
accounting 101 is crazy. But
yeah,
yeah, I mean, it just goes to show like how big of a discrepancy there is in the market. So then if you know enough, it's like
Yeah.
you might as well.
Yeah, that's the stuff I have an issue with. And look, if people want to gamble, they want to trade, they want to like, go for it. But please don't sit there and tell me like your funded account with a negative 10% EV is gonna somehow be like better than having a live account. That doesn't make any sense unless like you don't know how to like leverage, like literally just use options. You get the same amount of leverage as a funded account, except your EV is probably still negative, but it's not negative 10%. You know like a funded account is or no? Like the prop trading firms? Are you
I
familiar
don't
with them?
know too much about it, to be honest.
Oh, okay. Let me break it down so you kind of get an idea of why these things are a scam. So with the prop traded account, basically the way it works is you'll put in say $100. You'll put in okay. I'm gonna let up this guy so HD too, and I'll kind of break it down because I think this guy was waiting too, and I'll kind of break it down. Hey, HD2, how old are you?
Yeah, I'm 19.
Okay, and you said you did prop account trading.
Yeah.
And when you do prop account trading, you have to pass an evaluation, correct?
Yeah.
And how much money what's your drawdown versus how much you have to make?
Yeah, so drawdown depends on the account, but for like a 50K account is probably around like a 8 to 10% balance. So 50K probably $3,000 or two to three.
For your eval, I'm saying.
Yeah, so for the eval, it's probably 2,000.
Okay, and how much would you have to make
to pass 3?
Right. So basically, the way a prop account makes is a prop or funded account works is you have to pass this evaluation, and statistically, right there, the odds are against you because you have to make 1.5 times as much as you lose. If you lose 2K, you're out, but you have to make 150% to win. Is that right?
Yeah, yeah. Because it's not really about it's not really a 50K balance that you genuinely have to trade. It's rather that the 50K balance simply allows you to have a specific contract size, but really and truly, you're only trading about $3,000, and then you can't even
Right.
trade all of it because, yeah, just that statistically it's against you because we all know about an equity curve. You're probably going to go down into drawdown and lose the account before you ever gain the ability to build over time.
Right. And then the thing is, let's say all things held equal, you make no money. You win, lose the same, right? You have no strategy or no significant strategy. You have a zero EV. You assume the market is efficient for the most part, right?
I mean, in my case, I think it's a bit different. In my case,
I'm just saying generally. I'm not saying for you.
Yeah,
Just
yeah.
generally. Market's efficient,
Sure.
right?
Yeah.
You expect to win as much as you lose, right? 0%
Yes.
zero EV. Right. But they take 10% of your payout, right?
Well, so for instance, a lot of prop firms have a first 25 to 15 to 25,000 payouts where they give you 100% of those payouts and simply take away fees. And then after your first 25K payouts, then they started taking 9 to 10% split.
Okay.
I think
So-
some firms also have like 100% payout period.
Right. But generally it's a 10% fee, right? Generally.
Well, generally it's a 10% split after about a first 10 to 25,000 payouts.
Right. So that's the thing I'm getting at. So you'll put $1 in, right? You'll lose $1. You lose $1, you win $1, but you don't win $1. You win 90 cents. So that would mean you have a negative expected value. Your expected value is negative 10%. And we're not even counting how bad the odds of passing the eval are. So that's kind of the issue with these funded accounts.
Yeah, but I think so. What I think the difference is, because I talk to a lot of prop firm traders. I'm also a prop firm trader. I've been decently successful at Top Step. I think the majority of the problems that cause people to fail these evals are what we all know about psychological issues, right? Because if
Hold
you
up. Hold up. How does psychology impact the probability of like price movement?
Because if you lessen your contract sizes and you lessen your losses and your wins over time, you have more ability to then gain an equity curve over time.
So all you're making the argument is for is just lessen your variance or try to like have minimized variance?
Well, it's not necessarily only minimizing your variance. It's giving you the ability to exploit large moves in the market, right? So if you have, let me break it down. If you have 5 funded accounts, right, and you trade these 5 funded accounts similarly for most of the times, and then you try to exploit large moves in the market for like a variance where you can have a profit or you can have a buffer to then continue to trade with. All you need is a buffer to get payouts. So if you exploit large moves in the market rather than a small, slow, choppy move over time, you're never gonna be successful or have payouts.
But HD, are you making okay, but how do you know the market's going to move in that direction?
Well, that's the thing. You really don't have to. All you have to do is allow for the winners, the trades that are moving in the direction that you bet that it was going to move in. All you have to do is let those winners run and cut the losses short. When you see you're in drawdown, lower your risk. When you see you're actually making money, you can higher your risk and allow those wins or allow those periods of times where you have profitability to don't cut them short, essentially.
No, but HD, you don't know if the price is going to go up or down regardless of how it moved in the past. You're just
No,
assuming.
that's the point. So that's the point. So it is luck. You can call it luck if you want to, but when you allow those winners to actually trade up into these high profits, where you can have risk RR about like a 4 RR, 1 to 4. If you allow those 1 to 4 RR trades to play out, even though you're less likely to have a winning strategy over time, when you collect those big wins and you gain a buffer by exploiting those large moves, you don't have to predict those moves. All you have to do is be lucky enough to catch them to begin with.
Right. Okay. So then you don't really have any positive expected value. You're just gambling basically and getting lucky.
It's not gambling. I would say simply because it is based on how you trade. You could collect data on yourself, like personally. This is not, you can't quantify this across all traders. Me specifically, I've collected data and I've realized that when I take these 1 to 5 trades and I allow these 1 to 5 trades to go and hit those take profits rather than cutting those 1 to 5 trades short, I built a buffer. I am able to build a buffer. Whether or not that's statistically proven to be the case, when I let those 1 to 5 trades win, I now have a large enough buffer for my variance to be 1 to 1, right? To be an efficient market for me to have a 1 to 1 win rate and still have a buffer and still be able to take out payouts.
Right, but the question will be like the probability of you achieving that 5 versus 1.
Yeah, I get what you're saying. Yeah, but yeah,
Like,
yeah,
I
I
would
get what
be
you're
curious.
saying.
Like, are you familiar with like the odds of you hitting your target versus not, and like
Well,
how
yeah,
would you sort of
yeah,
interpret that?
yeah. So for instance, right, this is how you collect data on your specific markets. You can collect data on how you trade the MES, for instance, or the S&P 500, right? So I know that the average amount of ticks that
At least you're
the
trading
S&P, for
micro
instance.
contracts. I'm happy about that.
Say
So at
again?
least you said it makes me happy you said MES. We get all these
Right.
people up here from prop firm traders that are trading full contracts.
That's dumb. That's
Yeah.
pretty dumb. I'm gonna be honest. That's 1,000% gambling. For instance, I'm not gonna literally exclude myself from the gambling label because it is somewhat of a gamble. But yeah. So what I
Okay.
was saying is, yeah, you can have data collected upon how you trade your specific markets, which I trade the S&P 500, and I simply realized that over time, while I trade, that in a 2 week period, for instance, I'm like very likely to hit a 1 to 3 RR trade at least. So when I match those 1 to 3 RR trades with my risk amount, I lower my risk depending on when I get that buffer. If I don't have the buffer, the risk stays the same. When I do have
Yep.
the buffer, I increase the risk, right? But then, so even though I have these low win rates, because of that buffer over time, I'm still able to have a profitable outcome.
Yeah. I kind of get what you're saying. So effectively, okay, yeah, I get what you're saying. And what you're experiencing is this: you get positive variance at a smaller size, and then you take that, and then you make it a bigger trade, and you experience even more positive variance at a bigger level, and you kind of like build up from that. That's kind of what you're describing.
Right. Now, when I have those unprofitable runs, I lower that the loss amount, right? Like I remove most of the risk with the buffer. So then if I hit another 1 to 3 or 1 to 5 RR, even though I've lost so much, it still then brings my profitability back to a decent amount where it can at
I
least jump.
guess I understand what you're saying, but like I don't think you have real profitability. You just got lucky with the variance. You just had caught positive variance.
Well, that's the thing though. Let's look at it in the sense of an equity curve, right? For me specifically, I've been trading for about a year, right? I've been trading prop firms for about a year. I've been paper trading for at least 1.5. So when I first got into prop firms, for the first 2 months, I lost a lot. I blew about 25 accounts. That was about $3,000, right? As an 18-year-old. What I realized was you have to be able to exploit risk, right? A lot of people talk about risk management and they throw it around, and it's not, if you have risk management, you're profitable. That's not what it's about. All I'm saying is when you account for those positive variances in your trading, when you account for those and you simply allow those periods to really bring that buffer in, and then you lower those loss periods very minimally, right? You lower them to the point where in this period, even if I have a lot of losses, go ahead.
Also, when I say positive variance, I mean variance moving in the direction of the trader. Like their strategy doesn't actually have any significant, doesn't have any positive value. It's just trying, you're spinning a slot machine effectively, and you're winning money as opposed to losing money. That's probably the best way I could describe it.
Well, you're saying strategy. I'm talking about a system, right? You can talk about a system of trade that both includes a strategy and also includes your risk management and your RR, your fixed RR.
What you're describing is just trying to vary your risk management. You're not really describing a strategy that works. Just Varix never claimed to have a strategy that works. I guess I get what you're saying, but then you're effectively kind of just gambling at this point and trying to manage your risk.
Well, it's not gambling. For instance, when you gamble, you are literally restricted to a 1-1-0 sum game. You either lose or you either win. When it
Yeah,
comes to
hold
trading,
up.
though,
But HDT or two, sorry. The stock market is a zero sum game. If you win, someone has to lose. That's how the trading works. There's a
no,
loser.
no,
There's
but the difference is you're battling. Well, you can say battling, right? I'm just reducing the word to battling. You're
Yep.
not battling one person. It's not you win, I lose, then you win, I lose, and it's a 50-50%. I'm battling 1,000. You could, like, theoretically, right?
No,
Speaking,
but
you're
I get what you're
battling
saying too.
1,000 of
Yeah,
others.
but HD2, that's not what I'm saying. I get what you're saying too, but what I'm saying is it's still a zero sum game. If you win, someone else has to lose.
But your wins are not zero sum. It's not you win,
Yes, it
then
is.
you have to lose. I don't know, 50
Oh no,
50%
I get what
basis.
you're saying too. That's not what zero sum game refers to.
Yeah,
What
no, yeah, I know. I
yeah.
know.
What I'm saying is yeah, but like that's what I'm getting at. Like for trading to work, someone else has to be on the other side of your trade that was successful, and they have to lose for you to make money because it's a zero sum game.
Yes, liquidity had to be on the other end for you to then.
Right, and the
Yes,
part that
I agree.
and the part that I'm getting at is the provider of these instruments is not going to sell you something that they're not going to profit off of. That makes sense? Long term,
But
at least. Like
yes,
they're selling,
so
yeah, they're going to be selling you something with an edge.
yes, so the structure, yes, I agree. The revenue structure of prop firms is to pay those that have profitability over time by collecting revenue from those who lose mostly. So yes, prop firms are meant to exploit a bunch of gamblers that claim to be day traders. Yes, I agree.
Yeah, but I'm also saying for the stock market as a whole, it's basically just a casino at this point, really.
Well, yes, but as I've said, right? Yes. For instance, you can talk about the profitable traders that we probably know, Warren Buffett. We can talk about Wall Street guys. We know that the game that they've played over the times before they had all of this transparency in the market. You know, you talk pre 1940, like pre I think 1968, where they had to literally go out and physically try to trade these stocks with physical brokers and physical reality. And what they did,
What's your point?
what they did was literally let trades run into profit, because we know that over time the market is moves
Hold up.
upwards linearly. When you talk about
Yeah, but that's
United
investing.
States
Yeah,
exchange market,
HD2. Yeah, I get what you're saying, but that's like long-term investing. When you talk trading, yes, that's true that the stock market is more likely to go up than down purely because it goes up over time. But because the periods that you're trading in, a lot of the time it's so small. Yes, you capture some of the market going up, but it's a lot harder to capture that because since it goes up over a long period of time, the smaller your time window is, the less likely you're to capture that upward movement over time. Does that kind of make sense?
I get it 1,000%. Like,
Yeah.
yes, I get it 1,000%. I'm just saying, when you hit, like, I think that one of the most beneficial tools that you can have when it comes to prop firm trading is the ability to simply let trades run. Again, yes, I know when you
does that
talk
mean?
about micro movements and not micro movements, but when you talk about
But
short-term
HT2,
movements in the market, it
but
doesn't
HT2,
have a structure to likely to move upwards or likely to move downwards. Most of it is chop. I agree. We just talk about short-term day trading. The market likely moves in chops, right? But we know that.
hold up, wait, stop for sorry, like hold up for 1 second because I just wanted to like make sure this is clear before you go forward. Is when you say let it run into profit, trade into profit, what does that mean?
Okay, perfect. So the trades that you've managed to manage, like for instance, right? I'm not sure if you guys actually day trade or nothing, but on the day-to-day trades that you take, you can manage those trades. You can look when those trades are decently into profit, and then you can remove risk. I'm saying when you remove risk, you higher your likelihood to then lose the
How do
trade,
you
because it's
how do you remove risk?
by going break even. For instance, you remove the stop loss that you previously set. So you remove your stop loss and then put it to break even, now lowering the ability for you
But
to
hold up.
actually
Oh, I get it. Yeah, you're limiting your downside. I understand that part, but that doesn't change the probability of it moving in your direction. All it does is maybe if it hits your stop loss, you'll limit some of your losses, but it could also hit your stop loss and go right back up. Like you don't know if
No,
your
that's
stop
what I'm
loss
saying.
is wrong.
Yes,
It could also
what I
like
don't.
yeah,
I
it
have
can
a
increase
fixed
your
stop
risk.
loss. That's my
But
point.
like
I have
wait,
a
but
fixed stop loss. My stop loss
HD2.
never moves to break even. Never.
Yeah, but yeah, you understand how like if you were to move that to break even, that actually could accentuate your risk slash like decay your risk adjusted return.
Yes, that's what I said. I have a fixed stop loss. So I take a trade and I move. I literally close my computer. I close my platform. I'm saying, yes. As a matter of fact, I think there have been studies to prove that removing risk higher your chances of losing trades. Right? When you keep a fixed stop loss where you don't move to break even, for instance, the trade will come down and hit back down into drawdown, right? But then it has a likelihood to then revert back into profit. The more risk you have, the more likely you are to be in profit.
Oh wait, but HD2.
The
I
more
just
risk
want
you
to.
have, my bad.
Well, hold on, I just want to clarify something. But that doesn't actually remove the risk. All you're doing is you're limiting your downside. I agree with you there, but it doesn't actually remove the risk because it could still go against you. It's still just as likely to go against you. All you're doing
1,000%.
with yeah, but all you're doing with the stop loss is just if it happens to go past your stop loss, you won't take on that loss. But there's zero evidence that you could show that that stop loss prevented you from actually losing more money because all you're saying is like, oh, I think it's gonna if it hits this point, it's gonna go further down. As a point, you can just hit it, go right back up, and yeah, you get what I'm saying, or it doesn't like actually change your
Yes,
risk. It
but
just
that's the
limits your
thing
downside.
with me. That's the thing. This
Yeah.
is a basic premise, right? If you have more risk, you immediately have statistically less chances of a losing trade. You agree, correct?
Wait,
The
wait,
more
say again?
risk you have, the less likely you are to lose.
Well, no, not as
But
like
hold
in
on.
terms of where your stop loss is, because that's
Yeah,
not
but
really
then
your
also,
true
yeah,
risk.
I get what you're saying. But then also at the same time, you do realize that also means that you're limited in your return. Because if your stop
Yes.
loss is like higher up, then you get, yeah, because the risk, the variance, how much it jumps around is also like indicative
Yeah.
of your return. The
But
higher the risk,
your
the
true
return.
risk is the variance in your strategy, really. And
Yeah.
so, like,
Not necessarily, but what I'm saying is the more
no,
risk
it
you have, the
completely
more
is.
likely you are to the more risk you have, the more likely you are to have a trade that is in profit. Whether or not you decide to take that profit is up to you. But if you have a higher risk amount by lowering the amount of contract sizes that
No,
your
no,
your
But you're
position
not
has,
using the word.
no,
You're
you
not
don't.
using the
You
word
call it.
risk appropriately here.
Yeah,
what do you
all
mean?
you're all you're changing around is your variance. Your chance of profitability doesn't actually
No, he's not
change.
even changing. That the point is he's just adjusting his stop loss, but he's not
Yeah.
changing. He's not sort
I'm
of
not adjusting the size,
quantifying
correct? That's not the point.
the variance in the strategy itself. So, like,
What?
you could have a strategy that is literally the worst strategy in the world, and for instance, and you could put your stop loss at 100, just like ignoring units here, and then put your
Yeah.
target at 1, and you still lose every time because of the variance of your strategy or something like that.
Yes,
I mean, that would
but
honestly be like pretty impressive if you could lose like that. But point
yes,
being is
but
you're not
the
quantifying
idea
risk
is
appropriately.
the idea is the wider stop loss that you have, the more likely you are to return to a trade
Yeah,
with
I'm saying not
that's in
necessarily.
profit.
That's not
No, it's
true.
not. It's not a necessarily game. I'm not saying this as a absolute statement. I'm saying the higher risk amount you have, not the higher risk amount, but the wider stop loss that you have, the more you allow your trade to go down into drawdown, the more likely it is to return to profit. So when you have a wider stop loss, you are way more likely to a person who has a shorter stop loss to return to a trade that's in profit. Do you get what I'm saying?
Yeah, but your expected value of the trade that doesn't help the expected value.
No,
So
it
you
helps your ability to hit trades that still go down to drawdown, right? They
right,
go
but
down
if you
into
take those
drawdown and then
if you
not
take that same
occur.
trade over and over, that's gonna not necessarily increase your profitability.
Yeah.
It depends. Well, it depends. If
I
you
know.
decide to simply
Okay.
always
Guys, I'm gonna
ignore
end the live in
drawdown,
like a few minutes, but drop
yeah.
a follow. Guys, I'm
If
gonna
you
end the live
decide
soon.
to,
Good live.
yeah, my bad. If
No
you
worries.
decide to ignore drawdown, then obviously at some point you're going to be constantly in drawdown. That's not the point. The more drawdown you allow your account to be in, the more likely you are to return to profit. That's a fact. the more likely the more drawdown you allow your account to go down into, the more likely it is to then return to profit without procuring those losses.
This isn't telling us.
Can I say something real quick? So, like, for the most part, HD, like, you're really, like, what you're saying, a lot of it makes a lot of sense. You know, like, a lot of people, I'm sure, like, agreed with the majority of what you were saying. But then once what you're saying right now is, like, factually incorrect. So I think I understand why you're saying these things, because when you backtest on TradingView, I'm sure you've done this, is that when you increase the drawdown, if you increase, like, the stop loss, for example, your backtested strategies show up more profitable, right? Is that what you're talking about?
Well, that happens, yes. But
Yeah,
I'm
so,
talking
but
about our
that's not,
testing tools.
yeah, but what I'm saying is, like, that's not safe, bro. So it's like you're better off, like, being stricter on your trading and allow the numbers to work in your favor if you're trying to day trade over a longer period of time. So you don't want to optimize for every single trade. You want to optimize for the larger sum of trades that you would end up
It's
taking.
like, yeah, optimize your overall strategy as opposed to individual trades, because since you're going to be consistently performing the same thing, you want to make sure that your overall, like, the quantity of trades that have, like, decent risk management is higher than single trades that are, you know, as opposed to, like, you're kind of all over the place. I get that part too, but at the same time, like, I have to end the live stream soon, but I appreciate you joining HD too. And I kind of get what you're saying. You're just trying to, like, maximize your, you know what, you're trying to, like, maximize your likelihood to catch market drift. Is that what you're trying to do?
Initially, to allow those to give you a buffer.
Yeah, I get that. Yeah, I get what you're saying too. And, you know, I can't speak to whether or not that works, but I would imagine that it's probably, like, I don't think you probably don't have any alpha, and maybe you're just catching positive variance, meaning it just moves in your direction by chance, which I'm all for. You know, do whatever you want with your own money, like, but yeah.
He's
Also, I'm not-
effectively just
I'm
trying to
alive.
ignore like downside variance, and thus his risk adjusted return is just fucked.
Yeah,
What do you mean?
But also, guys, drop
No,
a
man,
follow
if you're getting payouts over a longer period of time, you're making payouts, man. Just learn what you're doing and, like, try to
And
fix
I've
what
had
you're doing wrong. You know
I've
what I mean?
had consistent payouts for about 6 to 7 months. It's
God
been
bless,
working.
bro. That's crazy.
Okay, but HD2, can you do what you're doing with the live account? Because that will make your returns a lot higher, because that 10% eats it up. But anyway, I have to end the live stream soon, but just look into if you can do what you're doing with the live account, and just try it, because that will actually make it so your returns are higher, which actually lowers your risk. But anyway,
Take care,
I
guys.
agree.
yeah.
Good stuff.
And be mindful, and be mindful. Do understand that you do have chance of, you know, losing money, and you want to be, like, you know, making sure that you're not gonna, like, lose everything. But anyway,
Yeah,
I'm gonna end the live stream now. Drop a follow if you enjoyed, guys. Thank you for everyone who joined. This is a good live stream. I liked it. Thank you, HD2.
All right,
Appreciate
have
it.
a good one. No problem.
Thank you. You too. No, I'll give it like a minute for people to follow if you guys still haven't followed. Thank you. What do you mean? Where do we go next? I don't understand what you mean by that, but anyway, I'm just gonna give it a minute. I'm gonna end it anyway, but I'll be on live tomorrow as well. So if you guys enjoyed this, you're more than welcome to join next time. And I definitely need to start making some videos about this, because I would love to be able to have videos that demonstrate what I'm talking about and the math that goes behind it, because I feel like that would, thank you for the heart. I feel like that would make it so that people have, like, a better understanding, as opposed to just kind of trying to understand it as we're in the middle of talking, and it's a lot harder to follow. But yeah, thank you. Anyway, about